This is not an end of bull market run. This is just a correction.
One thing that really stands out is how kind of rational or orderly a lot of the elements of the sell-off is.
I think we are in a situation where we are seeing pressure on many central banks.
The Fed is going to cut rates next year. That's what the equity market wants to hear in order to have a sustainable move higher.
The Fed will back off if inflation comes down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Snapping a 4-day losing streak and looking for a second day of gains. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market on the S&P 500 positive here by 0.4%, getting closer and closer to Chairman Powell in Jackson Hole. Let's start with this story right here. Does this sound like a weak labour market to you? American Airlines pilots approving a new contract that would provide 46% in cumulative pay raises and retirement contributions over a 4-year term. For the pilots, that sounds like a tight labour market to me.
This is a wonderful way to start the show at a time where people are worried about what this could mean going forward, given the fact that not that there are strikes, but that there aren't strikes because these companies are paying up. They are willing to give the extra money to all of these airline pilots and other workers. You saw that with UPS. You saw that with a whole host of others. So what does that say about how tight the labour market is and where the power has shifted?
$9.6 billion in incremental cost that we can discuss throughout this programme. And Lisa, this is the tension, the tug of war for Chairman Powell, the progress they've made on inflation over the last several months, the past year. At the same time, on the other side, a labour market that's still looking tight to me, which could mean perhaps inflation higher for longer, stickier, and rates higher for longer as well.
People are flirting with this idea. You have the likes of Nick Timiraos, who is often in the Wall Street Journal, someone who is thought of as a Fed whisperer, coming out with basically, will they or won't they start to adjust higher with a 3% target? No, they won't, because no, they can't do that because they won't stop there. But are they less willing to compromise a labor market that does look so strong and that a lot of people are cheering? The answer seems to be, not sure.
Let's get it to the bond market. Down 3 basis points this morning, but the move we've seen over the last few weeks has been phenomenal. A 10-year at the moment at 4.30, Lisa in the last 24 hours. Yields we have not seen since 2007.
Do we understand why? I mean, do we have a better sense? I mean, yes, the American Airlines deal that you struck, that you talked about earlier, the UPS deal, the fact that workers are getting paid, it all makes sense. The fact that there's a fiscal imbalance, that makes sense. The fact that suddenly we're looking at potentially the fastest growth in GDP going back years makes sense. Okay, but do we really understand why?
I think we've both said no one can agree on why. Pick a reason. There's 5 of them. Pick a reason. Most people sitting here picking their poison. And that's what's uncomfortable about this moment. Typically, when you see moves like this over the space of a month, really, really fast, we can all agree, consensus view on what's driving it. I think consensus view at the moment is all of the above. That's why I hear from most people and ask the same question every day. What's underpinning this move? And the response I get is all of the above.
Pretty much that this is the toxic brew that's causing yields to rise. I do think it's interesting, though, yesterday that you got a rally in tech stocks. You got a rally in stocks that previously were viewed as rate sensitive, even as yields hit their highest levels going back 16 years. What does that say about the consistency of the strength and how it's not going to be torpedoed by yields at these levels? Or at least that's the perception.
Here's another story for you. Yields up, banks down. Story of the month so far. Banks are down by about 8% on the S&P 500. S&P, joining Moody's, downgrading some banks overnight. Here's the quote from them. Depositors have, quote, shifted their funds into higher interest-bearing accounts, increasing the funding costs of banks. The decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. That explanation sounds like a decent characterization of what happened 4 or 5 months ago.
I was going to say the
in the
exact
US
same
banking
thing.
system.
This is an old story. Are they just playing catch up, or is this a persistent concern, especially at a time where we're seeing deposits go out of the large banks at a faster pace than some of the smaller banks that are actually offering up some yield? What I thought was interesting is that yesterday there was sort of this 1-2 punch. Charles Schwab coming out and saying that they were going to cut staff and cut real estate to save about $500 million of expenses a year. They were saying they were doing it because of investor pressure. And it comes then right after you get the S&P downgrades. Schwab shares are lower today. Investors aren't satisfied. What's going to satisfy them that there is some opportunity for strength at a time where there is yield to be had if you can capture it?
We'll pick up on that story later in the hour just to get you up to speed on the price action this morning. Equity futures on the S&P 500. A decent pop again. We're positive here, Lisa, by 0.4%.
Today, everyone's going to be talking about dollar and whether people can potentially abandon it. Leaders of the BRICS nations, that's Brazil, Russia, as well as India, China, and South Africa, are going to be meeting in Johannesburg. A lot of discussion about moving away from the dollar, a lot of animosity toward the dominance of the U.S. currency. That said, the dollar has really been a lot more resilient than people have expected so far this year. Amid all of that, retail earnings continue. We get Dick's Sporting Goods, Macy's before the bell, Urban Outfitters after the bell. We also get some housing stocks. Lowe's just came out, and we get Toll Brothers after the bell. Lowe's coming in, kind of within range. We'll go through that in a bit. And today, Fed Speak includes Richmond Fed President Tom Barkin, Chicago Fed President Austin Goolsbee, Fed Governor Michelle Bowman. Will they say anything? Yes. Will it mean anything for Fed Chair Jay Powell? Probably no, because he often takes a middle-of-the-road view that will probably say as little as possible if he takes the recommendations of you and Mohamed El-Erian.
Well, I think a lot of people have said the same thing, haven't they? Whether he goes with that recommendation, I don't know. But this week is going to be full of Fed Speak going into Jackson Hole and the annual Fed get-together kicking off later this week. Kicking off this show, Russ Kostrick, Global Allocation Fund Portfolio Manager over at BlackRock. Russ, new cycle high on a 10-year, 435. For you and the team, is that a buy?
You know, I think long term, you probably could look back 6 months, 12 months from now and say that, this was a decent entry point, but I don't think you chase it here. We are still moderately underweight duration in our multi-asset funds. And, again, I think you're getting to a point where you are getting some value back, but the long end is hard. And the reason the long end of the curve is hard, and I mean the 10-year or further out, is this question about how much of a premium should you get paid to own long duration bonds in an environment where inflation uncertainty is much higher than it used to be, at least compared to 5 years ago. And what the Fed is going to do is more uncertain. And that's what's been happening. People have been demanding that higher premium to go further out on the curve. And, that could go higher still.
Russ, pandemic low, 31 basis points on a 10-year intraday, early March. Russ, if I'd promised you 400 basis points more than that 3 years later, you would have ripped my arm off. Can you walk me through what's changed, why you think we're not going back to where we were pre-pandemic?
Sure, there are a bunch of things. And, the first and the obvious one was obviously an extreme, at a time when people had no idea if the economy was even going to be able to reopen. But the other two things are, obviously, we had the biggest surge in inflation in 40 years. And while headline has come down, core is still sticky. It's still, bouncing around 4.5%, and it's not collapsing. The labor market is at multi-decade tights. That's not changing very quickly. The Fed just finished the fastest tightening campaign in over 40 years, and there's considerable uncertainty about when they're going to be able to ease. Jonathan, you remember 4 or 5 months ago, the market was convinced that even though you had this rapid tightening cycle, by the end of the year, the Fed will be cutting. And that narrative has gone out the window. And now there's some uncertainty about when they'll be able to cut. So all of that together, the inflation, the uncertainty about the Fed, the resilience of the U.S. economy, that's left us in a very different place.
A year ago, if someone would have said that 10-year yields would be at 4.3, 4.4% almost, people would say that would absolutely break markets. It would break the economy. It would cause a recession. Now we're looking at equities that can look past this and keep rallying. At what point does something give? Can equities keep rallying in the face of yields that are at this level?
That's a great question, Lisa. And we spent a lot of time actually in the last couple of days debating that. And I think that there is a level that is going to be more of a headwind for equities. And obviously, we've had a tough August. But, it's interesting. And the dynamic of the market has changed. Last year, when we looked at how stocks were performing, it was all about this notion of rate beta. In other words, a stock sensitivity to interest rates. This year, it's not like it's gone away, but it's much less important than it was. And, you raised the point. 10-year at multi-year highs, the NASDAQ up 1.5% yesterday. Particularly the parts of the market, even the growth stocks that are stable growth, companies with strong cash flow, strong earnings, they have been able to move higher this year, even as rates have backed up. Now, there's a level where I think that starts to become an issue. But right now, at these levels, I think this is more of a headwind for those early growth companies, the unprofitable tech, than it is for some of the really stable mega cap names that have powered the market higher this year.
You said there is a level. What is that level, Russ?
I wish I could give you an exact number. Here's what I'm watching. So we have seen that real 10-year yields are starting to break out of that range, starting to break to 2% and higher. I'd be concerned if that continued. I think what would help the market is to see those real 10 years pull back below 180, let's say, in a level that was consistent with the range we've had for several months now. If you keep grinding higher on real rates, then I do think at some point you're going to start to see things break.
Russ, do you think it's odd that we're talking about real yields at 2%, multi-decade highs on nominal yields, and at the same time we're considering one of the biggest IPOs in this country in the last decade?
It's not crazy for a couple of reasons. The first of which is that, if you went back 15, 20 years, no one would have been, traumatized by a real 10-year at 2%. That was about what you'd expect. So we've gone back to normal rather than to some era we've never been before. But the other thing is, why are the 10-year yields up over the last several months? It's because we've all realized just how resilient the U.S. economy is. And back in March, when a recession was treated as a foregone conclusion, now 5 months later, we're looking at an economy that's likely to have a soft landing, where earnings are decent and may do better as we see that nominal growth hold up. And I think that's why the market's been resilient. And you can see these IPOs come back to market.
The soft landing that people keep talking about is predicated on the idea that the Fed is suddenly going to be patient. Not suddenly, is going to take a look at how quickly inflation has come down so far this year. It was going to do that anyway and say, we're not going to kill the labor market to get to 2% right away. How much is essentially the entire market coming to the view that the Fed is going to be less restrictive and more willing to allow inflation to run hot for longer in sort of this implicit 2-point-something goal for the 10-year Treasury yield and, frankly, for the benchmark rates?
I think there's definitely some of that baked into the narrative, and the question about, are they really going to force it to 2 or, do you get to 2.5 and declare a victory and go home? I think the other question is, the Fed has acknowledged this notion of long and variable lags, and you've already put monetary policy into restrictive territory. Are they willing to wait and be patient given the fact that we have seen inflation come down? So one of the things I think is going to be interesting as we get into Jackson Hole is how they address that, how Chair Powell addresses that, and the extent to which he acknowledges that we have seen with this backup in yields, a fairly significant tightening of financial conditions.
Hey, Russ, great to catch up. Get the team view. Russ
Thanks,
Kostrup there of BlackRock. Thank you, buddy. As always, big move in the bond market, just monster move in the bond market over the last month. Major moves over in China as well. Let's go to Hong Kong. The Hang Seng on a 7-day losing streak. Things were difficult. Then all of a sudden, late into the session, in a couple of minutes, Bramo, we rally about 2 percentage points on the Hang Seng. Head scratching. Questions being asked. Speculation. Maybe some funds have come in and done some buying on behalf of the state.
Well, yes, that's what people are looking at as the so-called national team, or what other people call the plunge protection patrol, coming in and staving off some of these declines. It wouldn't be the first time, and it would kind of pair with what they're doing in the currency market, trying to allow certain declines, but not too fast. Don't make it look too panicky. Stop being so dramatic about the situation. And that seems to be the theme that we keep hearing over in China. It's sort of playing a game of chicken.
Addressing the optics and not the substance of what's underpinning some of these moves. You can do something about the fix. You can come in and do some artificial buying if you want. I'm implying that's what it was. I'm not saying that's what it was because we don't know that's what it was. But ultimately, have you done anything to change the fundamentals? Because the policy shifts we've seen so far, a lot of people concluding they're insufficient, including the world's biggest miner. BHP Billiton came out with earnings, some of the weakest earnings we've seen from that miner in about 3 years. And they said what we've seen so far is just not changing the underlying story at all. Yeah,
but what will, right? Lisa Shallot was speaking with you yesterday. She said helicopter money. Well, are they going to do helicopter money right now? Is that even on the table? Is that really what it would take?
The fact that we are here in August and we've got guests like Lisa Shallot talking up helicopter money in China, when 8 months ago we were talking about reopening and a boom in the second largest economy, just goes to tell you how much things have changed. In the next hour on this equity market, Jill Carey-Hall of Bank of America, live from New York City this morning. Good morning.
the technological revolution that we think we're undergoing right now with generative AI, it didn't negate the idea of a recession. It postponed it, and I think that's part of the narrative. We are going to have a recession at some point. Business cycles are not canceled from things like this.
The brilliant Julian Emmanuel, Chief Equity Strategist over at Evercore, looking ahead to NVIDIA earnings after the close tomorrow. A big event for this market. Some people arguing perhaps bigger than what you may or may not hear from Chairman Powell later on this week. Into the market we go, where equities are firmer and positive on the S&P 500, up by 0.4%. So much attention in the bond market for good reason. 430 on a 10-year. Yields lower by 3 basis points. Yesterday, a new cycle high. For this cycle, that high, 435 on a US 10-year. Lisa, when we thought we'd left the highs behind back in October on a 10-year yield.
This comes despite concerns about banks that have anything but gone away. This comes despite concerns that the Fed is going to have to be more aggressive to curtail GDP that is reaccelerating. People looking out to the longer term and saying this is a new regime. This is a structural shift to higher inflation and higher term premia for U.S. debt.
We're speaking to Bill Dudley a little bit later this morning, the former New York Fed president. Here's a quote from his latest column. Allow me to read this to you. I strongly suspect that the bond bull market that began in the early 1980s is over. For the longer term, the steady economic expansion that followed the 2008 financial crisis is no longer relevant. The paradigm has shifted. Lisa, higher yields are back. The view this morning, and we'll talk more about it in the programme a little bit later on, the view this morning from the former New York Fed President Bill Dudley.
Russ Kosterich got on board with that. He was saying he's leaning in a little bit, nibbling a little bit into yield, into duration, but not that much because we are in a regime shift. So structural shifts, are they going to come out and do a Bill Dudley? We're in a new period of time, guys. Forget about bond returns.
Things you can say when you're no longer a Fed official. I always say that.
I'm heading into that.
File that firmly in that column, because if you heard that from a Fed official, that would be a big piece of news on Friday.
You remember when people used to say that low rates were actually restrictive in and of themselves and contributed to the low inflation? And all of a sudden now, on the margins, you hear people saying, well, if you're actually earning income on your cash, you can spend more money, and it's actually stimulative. I wonder if there's any discussion about that. It sounds counterintuitive, but it seems on the margins to kind of be true at this point.
I've got a name for you, Drew Mattis, MetLife, okay? I know that's Drew's view of the world. It was over the previous decade. I wonder if that's what he's focused on now as well. It's a curious time. Yields at multi-decade highs. At the same time, we are considering the third largest IPO ever stateside. Bloomberg's Alex Webb joins us now out of London. Alex, we used to cover ARM a long time ago when it was listed in London. Things have changed, buddy. Walk me through what's on the table here and what kind of valuation we could be looking at.
Yeah, so ARM was acquired, of course, by SoftBank in 2016, and we've not really heard much from them since then. Now, finally, of course, we've heard plenty from SoftBank about all the other things that have been going on. Finally, they have decided to bring it back to market, and notably, they're doing it in the US, not in the UK, much to the chagrin of a lot of British politicians. Now, they're talking about, well, the reporting suggests they want a $60 to $70 billion valuation. They might sell as much as 10% of the stock. When you look at the numbers, that valuation looks pretty punchy. It would be trading at a multiple that is likely to be a premium to the Philadelphia Stock Exchange Semiconductor Index. That's really the benchmark index for chip makers in the US. But it'd be doing so at a company that isn't growing right now. Now, much of the chip industry isn't growing. That's also why ARM isn't growing, because its designs are licensed to vast swathes of the chip industry. It is seeking a valuation that is not far different from, as a multiple of earnings, the likes of NVIDIA and AMD, but in the most recent quarter and the most recent year, it saw declining growth. That also suggests that it may not be quite as big an AI play as the prospectus would like you to believe.
Alex, before we get into that and talk about how it may go against the likes of NVIDIA, who report tomorrow after the close, can you run us through why this is so important for SoftBank to get a win after the difficulties they've had, not just over the last 12 months, but over the last several years?
To be honest, when you speak to some SoftBank investors, a lot of them sort of say, actually, we just want to get rid of ARM at this stage. That there's so much capital tied up in it. It was a $30 billion deal, 7 years ago. That almost any exit is a good one. If they get the valuation they're talking about, it's likely to be a return of about 100% from what they paid. That sounds like it might be good, but if you compare over the same time period the performance of the Philadelphia Stock Exchange Semiconductor Index, it's returned about 300% to investors. That's excluding dividends. So if you just put the money in a tracker fund, you might have done a little bit better if you're SoftBank. Nonetheless, freeing up that capital is something that they would like to do. The one caveat, again, is that they are only selling that 10%. If the stock performs better further down the line, there's scope, of course, to enjoy a better return on the lion's share of it.
How much is this IPO indicative of a market that's largely been frozen this year?
I mean, there are certainly a lot of people looking at this space. I did a piece for Business Week just last week, where there's some really fascinating sums. Private equity exits are at their lowest in a decade. And that part of that, of course, to do with interest rates. A lot of it is to do with the fact that the IPO markets have basically been closed. This will be a huge test of whether they might open up again. There are lots of companies sitting there ready to pull the trigger. Reporting suggests that Instacart might be about to go public, that the German maker of sandals, Birkenstock, may also be going public sometime soon. If ARM doesn't succeed, there may be some rethinks on that front.
That said, Instacart and Birkenstock aren't exactly established chip designers that are used in every single iPhone ever made. I mean, there's a real question around whether the market is open, but only for select companies. That was sort of what I'm getting at. Is this going to be an anomaly, or is this going to be an example of what market appetite could be?
I think if it's a success, that's no guarantee the other ones will be a success. If it's a failure, that's when you start to have a rethink for those other ones. To your point, yes, this is a core part of the chip industry. If there are investors in semiconductors or what people would say, fundamental technologies, who would say, if you believe in the long-term trajectory of the chip industry, you have to be in ARM. That's for the same reason you'd have to be in, say, TSMC, the big contract manufacturer in Taiwan. It is a massively important and almost systemically important player in the semiconductor industry. If it has a struggle getting out of the gate, then of course the IPO market has far bigger problems.
Can you believe Birkenstocks are a thing?
Yes, I like them.
Do you really? Are you a Birkenstock kind of person?
I don't have them, but
Okay.
I can appreciate them. I didn't take you to be a Birkenstock person.
No.
Not with socks.
Not me or TK. No, no. They wear socks with them too, don't they? Have you noticed? Yeah, I can't get on board with that. Alex, move on from that quickly. London, UK, at the epicenter of this proposed deal between Microsoft and Activision. Alex, can we close things there? Can they close that deal?
It increasingly looks like they might well do. There was an interview that the head of the CMA, that's the British regulator, the Competition and Markets Authority, did with Bloomberg Radio this morning. There was a real change in tone. She seemed very open now to approving that deal. There's been a big concession. The UK objection was very much to do with cloud gaming, whether Microsoft would get a dominant position in cloud gaming through the acquisition of Activision Blizzard. Now it's agreed to license its cloud gaming IP, its games, to Ubisoft for a period of 15 years. That takes the dominance off the table. If you look at the share price for both Activision Blizzard and Microsoft, they're trading up. Expectation is therefore that deal will be closed. Also, interestingly, Ubisoft trading up, as you would expect, perhaps, given the access it's getting to the likes of Call of Duty in the cloud gaming space.
Interesting. Alex, thanks for the update. As always, Alex Webb there out of London. Not lost on anybody that we're talking about yields at multi-decade highs, and at the same time, we're considering the third biggest IPO in US market history. There you go. Marko Kolanovic over at JP Morgan perhaps summing that up. Here's the quote. Compared to the start of the year, investor expectations, market positioning and the equity valuations have moved up. With soft no landing the new base case, there is no more fear. Marko says there is only complacency.
Or there's the battle between AI, the hopes and dreams, versus yields, the reality. Who's going to win?
Heidi Kribo-Rediker of the Council on Foreign Relations on China and the ongoing BRICS summit coming up shortly from New York City. This is Bloomberg. Having a look at a second day of gains on the S&P 500. Futures positive here by 0.4% on the S&P. On the Nasdaq, up by 0.6%. After yesterday at the close, still down on the month for the month of August by about 4% on the S&P 500. On the Nasdaq, after yesterday's gain, trimming those losses to around 5% or so. That's the equity story. In the bond market, I think you know the headlines, don't you? A 2-year yield closing above 5% in yesterday's session for the first time post-SVB, believe it or not, at least. So the 2-year this morning, 498.37. I know the 10-year's getting all the headlines for the right reasons, but can't take your eye off what's happening at the front end too.
Especially because suddenly you see almost a 50-50 chance that the Fed's going to hike rates again later this year. Just a couple of weeks ago, that was completely off the table. People were saying they were done. This comes at a time where only 2 other times the 2-year had crossed that 5% threshold since 2007. This is a rare occurrence. We're at new levels as people game out what the Fed has to do.
And we're back there right now, considering that after SVB, people thought cycle over. That was it. We had the ingredients for a tightening of financial conditions that would lead to potentially a recession, a hard landing, and the Fed backing away. The 10-year dropped to about 325, sub 325. Look at us now, 100 basis points north of that level in just several months.
And the problems are still there.
Yep.
So what happened, right? I mean, literally, we're seeing those problems highlighted again and again each morning. And yet people now think it's not a big deal. Everyone can look through it. It's almost, we tried that, tested it. We're good.
Highlighted again this morning, under surveillance this morning, China ramping up its defense of the yuan, pushing up funding costs in the offshore market and setting a new record with its reference rate for the currency. The yuan has been under pressure in recent months as China's economy continues to struggle. And Lisa, arguably this week, that struggle continues.
It's almost a game of chicken. Is it that they really want to keep the yuan stronger, or they just want to control how quickly it depreciates? There's a real issue here with trying to control the message through cosmetic adjustments or interventions in the market that don't address the real issue, and it's not working. So at what point is there some real reassessment of what has to be done, or an acknowledgement that they're not willing to, or they're not able to, or that they have a new paradigm? To me, this is the big question. People are looking at China's weakness and saying it's a positive because it might import disinflation. And they're saying that if it gets stronger, it's a positive because then they'll import goods. Why isn't it a negative for anyone? I mean, maybe it isn't. Maybe it's just, China loses and everybody else wins, but it doesn't seem that simple.
I think for plenty of people, it is a negative. It depends what you're focused on. If you're focused on inflation, great. If you're focused on growth, not so good, particularly if you're in Europe. So it depends what seat you're in as well. If you're here stateside looking at above trend growth, maybe you think you're decently insulated against this and less exposed anyway for structural reasons. If you're in Europe right now, Germany, for instance, just coming out of recession with inflation still too sticky, you've got a growth problem and an inflation problem. Rates are high, and the ECB, what's President Lagarde going to do over the next several months going into year end with those kind of forces, those kind of cross currents at the moment? Especially
when a strike over in Australia can send natural gas prices climbing significantly, and all of a sudden that becomes more of a headwind as well. I think there's an incredible irony here that Germany, the powerhouse, the economic powerhouse of Europe, is suddenly losing stature to the tourism-dominated southern nations in Europe that are seeing their economies outpace Germany by significant margins. Kind of changes the power structure a little bit.
Is there a German word for that?
Schadenfreude?
I think they would say there is a German word for
bit.
that. Yeah, maybe. For the Italians, the Spanish and the Greeks, perhaps. Lisa alluded to this story. S&P following Moody's in cutting their outlook on a number of US banks, citing a tough climate for lenders. S&P lowering their grades for a number of smaller banks, including KeyCorp and Comerica, writing, quote, "The decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen." Lisa, I guess you can say it now because it's true, but you could have said it several months ago as well.
And it hasn't really caused the credit crisis, and it hasn't caused profound illiquidity in a lot of these banks. That said, it is a slow-bleeding story. The fact that people have shrugged it off at a time when we are seeing yields continue to rise points to either the strength of these companies that they've convinced markets, or just the power of the narrative. It overwhelms everything. Everything is great, and people can power through even at yields at these high levels.
And not great for these stocks, that's for sure. S&P 500 banks closing close to 7% lower after yesterday's session. Worst month since March. You take the KBW Banks Index down almost 9%. Worst month since March, if we closed out August right here.
And I do think that the Charles Schwab move was an important one. They came out yesterday and said that they were going to cut staff and they were going to cut real estate to try to shore up about $500 million of costs a year. Their shares are lower in pre-market trading, even though they're saying that they're doing this to appease concerns of investors. It wasn't enough, or this doesn't work. It's unclear exactly what people are most worried about at this moment.
We opened the program with this story, so let's return to it. Pilots at American Airlines approving a new contract which would provide 46% in cumulative pay rises and retirement contribution over its 4-year term. The contract worth around $9.6 billion, making it the most expensive labour contract ever, Lisa, for a US airline.
So Bespoke Investment Group said perhaps what's most interesting about these labor negotiations is that there aren't the strikes, that actually the deals are getting done and that the companies are paying up because they are that desperate for labor. And that is how much the power spectrum has shifted to workers over companies. I just want to point to this. This contract also prevents against last-minute changes to some degree. I can just suggest that will lead to more plane cancellations. Like, on one hand, yes, it's wonderful for workers because that means that they're going to have a better life and they can plan their existences, which I think is fabulous. I'm just saying there is a, consequence to some of these things that might be felt to the other side, but people are still going to be willing to do it, as we've seen consistently.
Well, perhaps they'll attract the staff because that's been a problem over the last several years.
Did you ever want to be a pilot?
Yes, of course.
Was that like a phase for everybody?
As a kid, you watched Top Gun. Of course, you wanted to be a pilot.
So maybe are we going to get back to that, where people are like, they embrace it?
Not sort of like an American Airlines pilot, but like in a fighter jet. Abramowicz is different, of course.
Did you have
Did you have that dream? Everyone had that dream. Yeah, I had a leather jacket. Yeah.
No, I actually had a dream of, racing horses and stuff like that.
Racing horses?
Of doing...
You're telling me
things.
This wasn't a dream? This is the dream, Lisa. Heidi Krivo-Rediker joins us now, living the dream, Senior Fellow at the Council on Foreign Relations and Partner at International Capital Strategies. Heidi, wonderful to see you, as always. If you want to hear about China, I often go to the miners, and this is what BHP and the CEO had to say today. Beijing has put policies in place that are meant to stimulate new starts in the property sector, but we're not seeing that translate as effectively into changes on the ground as we were anticipating. Heidi, what is it about what China is trying to do but isn't achieving?
So I think, the problems are not entirely new that they're facing right now. And they've made a series of very bad policy choices over the course of COVID, the alliance with Russia. So they have, they're facing the demographic challenge, super challenged on debt. And you have this the deflation, disinflation conundrum that's starting to appear. And I think you really need to have some kind of something to actually, some kind of a national stimulus. But she is not really there because there is too much debt in the system and there's been a misallocation of resources. So it's sort of a very big puzzle to solve. And you're seeing a continuation of additional bad policy choices, like let's not tell anybody how bad things are really going, whether it's youth employment or in the banking system or any negative reports that could come out. So I think those they're sort of heading in the wrong direction when it comes to policy to address what is an increasingly challenging situation.
Heidi, you've worked in the Treasury Department, you've worked in the State Department, you've seen the flows of capital, you've really watched them closely. Is there any connection to the weakness that we're seeing in China and the sell-off that we're seeing in U.S. Treasuries?
So I don't know if we're looking at the connection between the two so much. I would keep them. I would think of them, in separate buckets. The challenges that we're seeing and the need for example, PBOC to intervene in yuan is it's really to stem domestic challenges and I guess you could make the connection of that there's capital that's coming out of China, but whether or not they're going into treasuries or not, unclear.
We're also looking at the questions swirling around China's economy at a time where this BRICS symposium is taking place, this Brazil, Russia, India, China, and South Africa looking to bring in more potential participants and talking about de-dollarization. Does this catch your attention right now in a greater way than it has before, or is this just basically a lot of noise to try to bring people to the table at a time where there's a lot of dissonance between these different members?
So there are, this is the big event that's happening today and tomorrow, the big it's the 15th BRICS meeting, summit of leaders, and Xi Jinping is actually going to be there. Putin is not. But you really have a mix of interests at the table. You don't have willing participants from you don't have India, for example, wanting to support a Sino-centric ambitious goal to counter the West, and there's not a clear plan of how the BRICS acronym will expand to a lot of other letters, and what that as an institution will actually do. Is it another UN General Assembly that they're putting together? And when it comes to the currency, the BRICS currency, they did take it off of the agenda because I think they realize that it's not particularly feasible. Dollar, until you have, until you actually have a deep, liquid, tradable currency that is, that can counter and challenge the dollar, and that would most likely be the euro. You're not going to see a BRICS currency per se actually evolve. One thing I always look to is Russia and India are using the rupee for trade. And you're seeing Russia with $1 billion of stranded assets in stranded rupees because they can't actually convert and use the currency because of sanctions. So it's complicated, but I don't see the challenge to the dollar as a real thing. Not that I'm sanguine, but I don't think this is going to be it. You might see, in addition to the euro, maybe in the distant future, some kind of a digital currency. But the challenge is not going to come for the BRICS.
It's super complex. The president was pretty blunt about some of these issues in the last couple of weeks, Heidi. Let's finish there. He called China a ticking time bomb, referring to their economy. He called some of the leadership there bad folks. He said bad folks do bad things. Heidi, from your perspective, what do you suppose the bad things are that we should be on the lookout for?
So the obvious bad thing is really the big question about Taiwan that hangs in the balance. When we look at the political and national security overlay with the Chinese economy, they've clearly prioritized national security in a way that is much more aggressive than anything that we really understand. And so with youth unemployment, I always look to youth unemployment and the fact that they are not publishing the statistics anymore is really not going to make the problem go away. You have additional studies coming out with how many Chinese have really taken to not being interested in participating in the labor market at all. You have college grads that are delivering coffee. You had a one-child policy that gave a whole generation of kids whose parents focused on getting them to a better place, and now they can't find jobs in a place where the demographics are that ticking time bomb. I think that is one very big ticking time bomb.
Yeah.
So but I think that was probably where President Biden was going with this. But there are multifaceted challenges there, and I do think that if domestic security is going to be an issue, it's because of the youth unemployment issue.
We're certainly focused on it, except we're not going to be able to hear anything about it because they're not going to publish it anymore, as you suggested, Heidi. Thank you. Heidi Krieber-Rediker, that school of thought here that as things get harder with the economy, they become more assertive on national security issues. Heidi Krieber-Rediker. Up next, the prospect of 6% on a 10-year yield. Katie Kaminsky of Alpha Simplex from New York. This is Bloomberg.
This isn't yet about any kind of growth slowdown. Fed is still saying that a period of below trend growth is going to be necessary to get that quote unquote last mile of inflation. The danger is that with growth so resilient, the Fed shouldn't be showing as many cuts in 2024, even as inflation has come down.
The brilliant Luke Howard there of UBS Asset Management in the last 24 hours. AMH writes in, be kind to Birkenstock.
Interesting.
I would not have guessed that AMH was a Birkenstock kind of person.
She'll have to set that record
I'm
straight
shocked
in
about
about,
that, actually.
I don't know, half an hour time. She'll
Joined us
come
in
on
40
and
minutes.
She'll talk about it.
She thought she'd be talking about the GOP debate taking place
she's
tomorrow.
Not. She's going to talk about Birkenstocks.
And the lineup that was confirmed. But yeah, we'll talk about that. An IPO in prospect maybe later this year.
I don't understand your sort of aversion to them.
Sandals and socks in New York City.
Put away the socks for a second.
Time and place.
Okay.
Manhattan.
Okay, but just in general, as a shoe.
I think there's a place for that. And it's not Manhattan.
Do you have sandals?
No.
What the heck do you wear on the beach?
I think there's a place for that.
Okay.
You take your socks off, don't you? You walk around. Why would I wear sandals on the beach? Get in the sea. You wear sandals in the sea.
Well, no, but you take them off. You have to wash off your feet. It's sort of an easy, you sort of, if the sand is hot and you're walking across it, you want to have something to protect the bottoms of your feet.
Good chat.
Okay, this is good.
I miss TK for this. Tom would be so on board with all of this.
Well,
How's this for a quote? Let's play Guess Who. Okay, this is serious now. Here's the quote. Last year, we had a ton of short signals, but the only one that seems to be somewhat persisting going into this year is short bonds. That's really because it's a contrarian signal. It's something that few people really want or are confident with. I'll give you the date, early January of 2023, and I'll give you the name, Katie Kaminsky. Katie Kaminsky joins us now, Chief Research Strategist at Alpha Simplex. Katie, what a call at the start of the year. This short that you've held on bonds is paying off in a big way over the last month. You've put out a headline and you knew it would get attention. You've raised the prospect to going to 6. So let's breathe some life into that conversation. What is it that you saw at the start of the year that's continuing now and you think these forces are here to stay?
Yeah, so we've seen short signals in fixed income all year, albeit not as strong as last year. But what's really interesting about this, particularly recently, is we've started to see the market agree with us. And we've also seen some of the fundamental players out there say, this might have to happen. Higher rates for longer.
So, Katie, is it time to back away, considering at the start of the year it was contrarian? Why is it a move you want to stick with?
Well, this is a really good question because I've been asking myself this as well, is that if we've looked at the data with technical signals, when the curve is still inverted, trend signals short tend to work really well. As we see a flatter curve, it becomes more mixed. And if we can see a steeper curve, I plan that we're probably going to be long. So we're still within that transition period where we could have a very interesting trend environment as we see the curve flatten out and everyone realize, why hold long-term debt when you can have such a good return short-term? And if the data isn't clear that we're going to cut rates quickly. It's a sticky inflation play. It's a question about long-term cash flows. And I think people are starting to really realize this is the real issue.
Katie, every single day we ask people, why now? The bond sell-off is something people were talking about for quite a while. Suddenly, it seems to be reasserting itself. Do you have an answer to the now of the sell-off?
Yes, I really think it has to do with behavior. And I think that everyone would rather wait to see if something is going to come to fruition. And that's exactly what you're seeing this week. Everyone's sitting around waiting to hear commentary. They're pretty sure they know what it's going to be. And I think the real truth is that we're starting to see the data is pretty consistent with the narrative that this is going to take some time and that higher rates could be part of what is the new normal in a world where we've experienced so much inflation and sort of a very different post-pandemic economy. And I think that's where it's starting to turn around. And I'm starting to see fundamental investors agree with the technical signals.
How important is it that stocks have been able to rally in the face of higher yields? Does this sort of edify the idea that this is sustainable and something people can lean into, that yields are going to stay this high and the whole world isn't going to collapse as a result?
Yeah, that's a tricky one because I think the backdrop of yesterday, so yesterday definitely brought that to light. You saw an environment where stocks were up, the Nasdaq was up a ton, and yields were up to 16-year highs. That's a weird situation for markets. I think if it's actually the case that those two things coincide, it means the market's accepting higher rates, which could be a good thing. On the other hand, I'd be a little skeptical of how big of a move we've had this month. We could have just had a little bit of relief rally yesterday. So I think we need to watch that correlation trade a little bit more closely going forward and see if this positive correlation environment is actually going to stick.
Hey, Katie, we can see the rates on the screen. I just wonder how many people are paying them. Katie, we haven't had the great refinancing yet. Some people maybe think it begins next year in high yield. Katie, do you think this economy can tolerate these kind of rates beyond, say, 6 to 9 months?
This is the really tough question. And I think that's what March showed us, is that suddenly it seems like people wake up and they say, wait a minute, there's a good deal for yield here, or this isn't working. And I think it's very hard to predict when people are actually going to refinance and when those particular events are either going to change their behavior. The truth is people behave differently in a higher rate environment. We've seen that shift in short-term rates. We haven't seen it in high yield. We haven't seen it in long-term debt yet. This week was interesting to me because it said people might be starting to wake up. You're starting to see headlines about selling treasuries. You guys were just asking about that. Could it be the time? Maybe this fall.
Katie, just one more question. The 6%, the number 6, that gets a lot of attention. Is that actually a call from you? Is that a forecast?
No, we don't forecast, but we do see trends in data. And if you look over longer term horizons, 6% isn't a crazy number for a 10-year. I know it is for those of us that have been living in, a decade of really low interest rates. But those of us who look at the technical signals and long-term historical patterns, what you see is that that's not a restrictive rate for many periods in economic history. So it's not strange to think that we might have higher rates if we have surprises on the upside in inflation in the fall.
Katie, great call to start the year. Just fantastic, and great to catch up with you late into August. Katie Kaminsky there of Alpha Simplex on this bond market and why potentially you can go as high as 6% on a US 10-year. Lisa, it's not the new normal, it's the old normal. It's the old normal that many of these guests keep reflecting on.
Bear with me. Something that I've been thinking about for a little bit of thought exercise. If you're really able to earn 5%, let's say 6%, let's go to Katie's conceptual figure there on 10-year treasury yields. Let's say you're earning that amount of money and you're borrowing money at 7% or even 6%, then it's a wash, right? So at a certain point, if you have assets, you could see how people could extend themselves and it not make a difference, right? It sort of depends on what the assets that people have. In other words, does this end up disproportionately affecting people who are on the lowest ends of the savings and income sphere while allowing the luxury, the top end to keep chugging along and even doing better when you actually are getting yields, that stimulative effect of yields that are no longer at zero?
Oh, to be blunt, without a doubt. Without a doubt. Obviously, if I'm cash rich, asset rich, I'm fine.
You're doing great.
If I'm not so great. I've been wanting this for ages. If you're sitting there with a ton of savings, 5-6% interest, wonderful.
Yeah.
It's absolutely fantastic.
And you're risk averse and you have certain constraints around you for what you can invest in.
Right now,
I'm just saying that if you, for a little bit maybe, but I'm just saying, you think about how that changes a dynamic in a more material way that isn't being factored in because people automatically think high rates restrictive, low rates stimulative. And this was really a question, a sort of existential question during the era of monetary repression. Is that contributing to low inflation? Is it going to be the reverse as we start to see yields stay at higher levels?
This operates on different timelines. Wait. It doesn't seem restrictive now. If we're going to have the great refinancing that begins at some point next year, particularly in high yield, look at what they borrowed at in the last couple of years and look what they'd have to borrow at now in this market. It's a monster change that we'd have to digest.
So that's what I've been feeling and thinking. And then I was reading some stories and looking at the data yesterday about all the CCC companies that have either refinanced or restructured and really worked to extend that window out. I'm just raising this prospect that maybe it's more than just 1 year, 2 years, 3 years, that people have insulated themselves. And if that's the case, I don't know. It's hard to understand the transmission mechanism of high rates in this economy, given the lack of effect that it's had so far.
Oh, that's been a huge difficulty over the last 12, 18 months. And it's why we're still sitting here wondering, are those lags super short or just super long? Jill Carey-Hall of Bank of America is going to join us a little bit later. We'll wrap up some of the retail earnings as well with Chuck Grom in about an hour from now from Gordon Haskett. Macy's, just out moments ago, we'll recap this in just a couple of minutes, reaffirming their annual sales and earnings guidance. That news out just moments ago. That stock is up by 1%. Equities up here by 0.4% on the S&P 500, with yields just a little bit lower, but close to multi-decade highs. From New York, good morning.
This is not an end of bull market run. This is just a correction.
One thing that really stands out is how kind of rational or orderly a lot of the elements of the sell-off is.
I think we are in a situation where we are seeing pressure on many central banks.
The Fed is going to cut rates next year. That's what the equity market wants to hear in order to have a sustainable move higher.
The Fed will back off if inflation comes down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This has not been a quiet August at all. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro, snapping a 4-day losing streak on the S&P 500 in yesterday's session and adding just a little bit more weight to the S&P 500. Equities up here by 0.5%. There have been many surprises for 2023. The US economy has been one. Upside surprise after upside surprise. Consumer discretionary very much in focus with the Airlines and the cruise operators. Bramo retail in focus this morning all over again.
We've been getting a slew of earnings, whether it's Macy's, whether it's Lowe's, Dick's Sporting Goods, and we will work through all of them. But the highlight really is resilience, and we keep seeing that despite some concerns. We've seen that in the shares. So far, year to date, people continue to spend, and that has been the story.
This sets up the conversation for us pretty well with Chairman Powell on Friday. That speech, 10:05 Eastern Time at Jackson Hole, Wyoming, that annual Fed get-together. I'm sure you're all familiar with that time now. Lisa, just how resilient is this economy going to be? How can consumer discretionary spending hold up in the face of 5.5% interest rates?
If people are getting 48% increases in their wages or whatever the latest labor agreement was with American Airlines, then they can afford it. If you can see inflation coming in, wage increases continuing to maintain at the pace that they have, real incomes will continue to increase. And then all of a sudden, disposable income. That's the perfect world. People are shrugging it off and saying, just wait, just wait. But this goes to this question of how long do you wait before you start to say, maybe my assumption isn't so accurate.
46%, but what's 2 points between friends?
I knew you would correct it. Which is good. That's the reason why I was waiting for it.
As well.
Exactly.
Everybody's going to see these headlines. They're all going to see them. UPS at the end of this contract, what is it, 170,000? Something like that. You can correct me if I'm wrong.
No.
The airlines, 46%. Cumulative pay rises, benefits, retirement contributions over this 4-year term. Everyone's going to see these headlines. They're going to go to their employer. Aren't they going to ask for the same thing?
Well, and there are reports. There was a Wall Street Journal article overnight that talked about how actually when people are looking for jobs, they're seeing the increases they potentially could get in their wages that aren't as big as they used to be. So there is signs of a bit of cooling on the margins. But yes, I take your point that right now there has been a shift to labor, and it doesn't seem to be diminishing even as we're a year into this tightening cycle, and we're at the highest levels going back 16 years.
You've mentioned this a few times. You've raised the question. You've asked it. I don't think either of us have drawn any conclusions on it. But ultimately, is there a window here where you have to deal with it before it gets embedded into the system, before we start discussing that wage price spiral that we've been talking about for the last 18 months?
The Fed does not seem worried about a wage price spiral right now because they keep saying that, yes, wages are coming in, but it raises a question of embedded inflation expectations that are good and inflation expectations that are bad. We keep hearing discussion around whether the Fed will allow 3% inflation as a target. Is that embedded inflation expectations, or is that healthy? Are people going to be talking about that at Jackson Hole? Not out loud, but behind the corners, yes, I expect that to be a significant conversation as people game out what the correct policy is.
If they are behind the scenes, we'll bring them to you on air, of course. Equity futures right now on the S&P positive by 0.4%. There has been a lift in this equity market the last couple of days, but really the dominant story for the last month has been in fixed income in the bond market. A new cycle high on a 10-year, 4.35 this morning. Lisa, yields lower by 3 basis points at about 4.30.62.
You mentioned retail earnings, and we have been getting a slew of earnings. We just got Macy's, Dick's Sporting Goods. I want to start with Dick's. We also got Lowe's, which is positive. Dick's Sporting Goods came out below expectations with net sales and EPS that came in lower than expected, as those shares are lower by more than 18%. Not so when it comes to Lowe's. Those shares are popping as people do look to an upgraded forecast going forward. Contract work because people aren't moving, so they're making their homes nice. That seems to be part of it. And Macy's reaffirming guidance. Those shares 4.5% gain. So again, the strength there. Dick's perhaps a different story. Maybe people have all the fishing rods and hiking gear that they need. Today, we also are talking about the leaders of the BRICS nations, Brazil, Russia, India, China, South Africa, talking in Johannesburg. talking about how to move closer together to counter G7, questions about the dollar, whether they're going to counter that. We just got that shot down in the last conversation with Heidi Kreber-Rediker. We will be talking about, though, on an ongoing basis. And today, Fed speak ahead of Jackson Hole. Richmond Fed President Tom Barkin. He will join in about half an hour, not here, but he will join somewhere. And Chicago Fed President Austin Goolsbee and Fed Governor Michelle Bowman will be speaking throughout the day as they sort of give their divergent views on how to handle this. I'm not expecting to hear much from any of them because all of them don't really have much to gain, John, by really saying anything too aggressive right now. The market is moving in their direction. They want to see yields moving higher. And then the fact that you're seeing the markets hang in there, well, isn't that kind of a good thing?
I hope Tom Barkin knows where he's meant to be. I hope he knows.
I assume. Look, if he shows up here, I won't get upset.
I was laughing as you did the stock check. You know, dicks call their customers athletes.
I know.
And you start discussing fishing and stuff like that. Is fishing a sport? Athletes.
Do you think that golf is a sport?
I do, yeah.
Okay, then why isn't fishing a sport?
They don't move, do they?
Well, it depends if you're fly fishing. You've got to wade through the water.
You wade through it?
And then you have to cast.
Okay.
I mean, how it's like this versus this.
Okay.
It's like...
Thanks for that. Yeah. That's a good question. Deep stuff here, Bramo. Joe Carey-Hall with us, head of US small and mid-cap strategies at Bank of America Securities. Joe, good to see you.
Good
morning.
See you, Joe.
You've upgraded your view on consumer discretionary. It's pretty interesting. Can you walk us through why?
Sure. I think, as you were saying, the consumer has been holding up well. Real wage growth turned positive for the first time in 2 years. Even though we have higher rates in the U.S., consumers are a lot better positioned than a lot of regions with, fixed rate mortgages. So I think, the consumer has been solid. We're seeing a potential shift from services spending doing really well to now, goods spending has been starting to turn a bit. Consumer discretionary is more exposed to goods spending. And I think, positioning when we've looked at, fund manager holdings of consumer discretionary stocks is at extreme lows. So, I think from that perspective and, the sector has started to rank better in our quant work as well. If we are moving into more of a recovery environment, if the Fed is done hiking soon, that's usually when the consumer discretionary sector tends to start to work.
It was supported by all of this pandemic savings, and we're told repeatedly that's being burnt out. Apparently this is the quarter, according to some studies. We've been told that quarter after quarter for the last year, but let's go with it. Let's say this is the quarter. Do you think we can have this seamless handover from the support we got from savings to the support you could get from a tight labour market?
Yeah, I think, the key part there is that it was excess savings and, returning to obviously just normal savings trends. If consumers are feeling good and have higher wages, I think there's still potential for consumers to spend. And we've seen this earnings season so far, the consumer discretionary sector, obviously still seeing some retail earnings come in, but the sector has seen some of the strongest results among all of the sectors so far, really large beats on the top and bottom line. So, so far the trends for the sector have been holding up well, even this earnings season.
I've been looking at the S&P consumer discretionary bucket. Shares up 28% since mid-March during some of the peak of the concerns going back to the banking crisis. There's already been a lot baked in, and we're seeing yields go higher. If yields continue their sustained move or stay where they are you concerned about going overweight given how far the stocks have already gone?
I think, valuation does look a little bit expensive when you take out some of the largest stocks in terms of Amazon and Tesla. Valuations definitely look more reasonable. And then also if you kind of compare it to consumer staples. So we had downgraded consumer staples when we upgraded discretionary. A lot of our overweight sectors right now have a more cyclical tilt. I think at this point in the cycle, this is when we think it makes sense to be a bit more cyclical. That's where active managers, like I said, are very under-positioned. Both hedge funds and long-only funds, they're positioning in cyclical sectors relative to defensive sectors is at pretty extremely low levels when you compare it to the last, decade or two.
What would you say to people who argue that some of these cyclical companies are more leveraged to where we are in the yield space, have to borrow more money, have to be exposed to higher borrowing costs in a more predictable manner, and that they therefore could be hurt by that?
Yeah, I think there's certainly some sectors where that's a lot of risk. I mean, I think in the high yield market, some of the areas that our strategists have seen the bigger risk has been in, TMT and healthcare. Those are some of the areas where for small caps, which is an area where I'm tactically positive right now, but I think medium term, there are certainly more risks around refinancing. That's an area where a lot of, healthcare and TMT stocks are the non-profitable, non-earners. A number of sectors like real estate have very high refinancing risk. So I think it's something that investors definitely want to pay attention to. Having screens on leverage and on short-term and floating rate debt is a factor that I think is going to become more important than it has in the past.
Jill, banks. Yields up, banks down. Let's finish there. Why are yields up and banks are down? What's going on with banks?
Well, I think, banks, we've started to see, actually, when I look at our flow data, after a long period of, underperformance and uncertainty after March, we've actually started to see a pattern of inflows there. We've obviously been through earnings season. I think right now we're waiting to look at, how banks react, credit conditions, all of that. We've seen a period of stability. I think, when we look at all of the sectors across the board, banks are still one that ranks well in our work, especially in large caps. I think in smaller caps, you want to be a little more cautious given the exposure to regionals and the higher regulation risk, which could impact multiples. But for a lot of the larger banks, these are higher quality. They've after the last crisis kind of cleaned up their balance sheets and look a lot better than they did heading into that crisis. So, again, another cyclical sector that, in our work looks relatively well positioned.
Preference still equal weight S&P 500 for you and the team?
Yeah, so we've had a 4,300 target on the market. I think we saw very strong mega cap leadership earlier in the year. Very narrow leadership that started to broaden out the last couple of months. So that's sort of our continued expectation is that the equal weighted S&P 500 will lead the cap weighted S&P 500 from here. More of a broadening out of leadership. Small caps could see a recovery rally tactically.
It's amazing. 2 weeks ago, that was like consensus view. Few weeks of a bond market sell-off and it's like, oh no, hard landing, no landing again? Is that what we're doing again?
Well, right now I think that there's that noise on one side, and it seems like stock players are playing on a totally other sphere. They're just basically looking past it, like bond markets are going to freak out, and then they're going to come back, and we're going to just keep chugging along. The earnings seem pretty good.
Hey, Jill, good to see you. Thank you for the update. Thank you. Jill Carey-Hall there of Bank of America. If you are just tuning in, welcome to the programme. The S&P 500 positive here by 0.4%. Coming up in the next hour, Monica DeCenso of JP Morgan. We need to talk about this bond market. The 2-year through 5% at the close yesterday for the first time post-SVB failure. Lisa, what a turnaround. Look at the charts for fixed income, just filling the gap over the last few months.
And erasing the game that was trying to give some reprieve to people from last year's losses in the bond market. I suspect that you've been getting some feedback on sports and what counts as sports and not, and sort of the list of things,
Dressage, artistic swimming, ballroom dancing.
And you think no, right, to all of those?
I'm not going to express my opinion just in case
you just did.
I offend the many. I might offend the many Bloomberg terminal users that are into artistic swimming.
I personally, I actually.
No, your audience, Bramo.
If you are into artistic swimming, please write in. I want to talk to you because I actually would argue that it is a sport and that curling is a sport. Do you know that when
There's
I was
a club for terminal users?
What?
For artistic swimming. Yeah, they get together Thursday afternoons.
You can't even keep a straight face. No, they don't.
They get together Thursday afternoons.
No, that's just not true.
They do.
You're making this up.
Stop stereotyping people, Lisa. It's rude. Kennedy Goldberg of TD Securities on Climate Yields joining us in about 17 minutes' time. This bond market's been phenomenal. New highs on a 10-year, highs we haven't seen since 2007, on a 30-year, highs we haven't seen in more than a decade on a real yield. Real yields at 2% on a 10-year. And an equity market that's bouncing back up by 0.4% on the S&P.
Not paying attention.
Potentially a second day of gains on the S&P 500. Your 10-year this morning, 431.22. Up next, we'll head down to Washington, D.C. and catch up with Bloomberg's Anne-Marie.
to come out. If we want the equity market to settle down and we want yields to settle down and then be able to continue the move higher for the equity markets, Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Everyone looking into their crystal balls trying to work out what Chairman Powell's going to say on Friday in Jackson Hole, Wyoming. It's amazing what Bloomberg terminal users get fired up about. Here's a quote for you, a direct line from a user. It is massively impressive and a brilliant discipline. It ain't a sport. There you go, on artistic swimming.
And here's another one.
For whatever that's worth.
In the South, artistic swimming refers to someone's ability to stay afloat without spilling their beer.
Okay. There we go. That's how people feel about it this morning.
I'm glad that
it's good to know.
Got everyone.
Good to know they're focused on that and
not anything else that we're talking about.
Not going to share any names. The equity market on the S&P 500, by the way, if you're tuning in for that, and I'm sure many of you are, positive by 0.4%. Equities a little bit higher in the face of yields near multi-decade highs. The 10-year this morning is lower by a couple of basis points, 431.42. After Chairman Powell, there's still some data to come. Early September, I think the very first day of September, there's a payrolls report, Lisa, and then it's on to September 13th for CPI, and then the back end of the month, the Fed meeting.
They're data dependent. That's what we hear. So
apparently, yeah.
Evidently, which data is going to actually make it or break it for them? And at what point is it 3-month trailing? Is it the revisions? What's going to exactly cause some sort of reality check where they feel like they're on the right path? Before we get to all of that, we've got a GOP debate over in Milwaukee. We want to follow the money. That's what we do. So here's the quote for you from the team here at Bloomberg. The former president holds more than a 40-point lead in the Real Clear Politics average of national polls and has the money to match it. Listen to these numbers. His legions of grassroots donors have poured in more than $61 million into his coffers since he officially launched his third bid for the White House back in November. Compare that to second place, the governor of Florida, Ron DeSantis. More than 3 times what DeSantis, the former president's nearest rival, has raised since entering the race back in May. The fact that the former president, Donald Trump, is not going to be on that stage with the other contenders puts so much focus on Ron DeSantis as the runner-up and who's he going to cede his helm to, because there seems to be a feeling he's losing a lot of momentum. Who's going to pick it up on the other side? Joining us now down in Washington, Bloomberg's Anne-Marie, our chief Washington correspondent. AMH, follow the money. How much money is just sitting there on the sidelines, waiting for these debates to work out where that money should go?
Well, I think a lot of it when it comes to the major donors who everyone thought was really going to pile in heavy throughout the summer on Governor DeSantis. And a lot of them are just taking pause and they're waiting to see if there's a potential another candidate that rises. We have seen this restart from Governor DeSantis' campaign, and it hasn't actually worked. What I think is so interesting about the money, though, is when you look at the grassroots enthusiasm. That's where you can see a lot of the base decide really who they want to put these lower level capital money into candidates. So Nikki Haley is really a star when it comes to that, obviously, besides Trump. And then there's another individual that the data and the money really shows potentially this person could start to shine. And that is Senator Tim Scott. About 40% of his donors also donate to the former president. And that is the biggest amongst all these candidates. So when it comes to a group of people who are giving to the former president, 40% of them for Tim Scott are also going to him. So that's an interesting number to look at. But when it comes to the former president and you look at all this money he has, those resources could potentially be drying up very quickly. And this week is going to prove that. When he shows up on Thursday, he says he's going on Thursday to Fulton County, Georgia, to turn himself in. This is going to be on his 4th indictment. What do you expect the actual debate to look like without the former president and with his counter-programming on X? That's the latest that we are hearing with Tucker Carlson. Yeah, and that does look like that interview has already actually wrapped up. They're just waiting to hit play on X. His counter-programming, former president sitting down with Tucker Carlson, who also used to be a former Fox News host. So I think without the former president on the stage, it does give a little bit more air and breathing room for these candidates to actually talk about policy. And if you looked at some of the latest polls, That's what voters are craving for. They want to hear what these individuals have to say, not about the former president, which they're constantly asked about, but actually about policy initiatives. Most notably, what is their path regarding the economy, and what are they going to do to bring inflation down, which many voters continue to say is still hammering them when it comes to higher grocery bills, higher rent, higher energy prices. So I think without the former president physically in the room, there is going to be these avenues for them to explore actual policy dialogue. The issue is, of course, the hosts are going to have to ask about the former president. These candidates are not just trying to vie to be the nominee to beat President Biden. They also need to deal with this incumbent within their own party who is dominating in the polls.
Do we have a sense of how much the core of the Republican Party are people who are pretty concretely in Trump's camp versus people who are open and are going to be watching the debate to really see what the issues are and parse through who else they can get behind?
Well, Trump holds the base continuously, and that's about 30% of the Republican Party. What was interesting in a recent Iowa Des Moines Register and NBC poll was that individuals are open to their second choice candidate. There is an openness in Iowa, too. So if Trump's there first, they are still open to their second choice candidate. And they also have high favorability ratings for an individual like Senator Tim Scott. But these individuals have yet to break out. So it's not said and done that Trump is going to be the nominee. Obviously, if you look across the polls and you see his wide margins, more than 60% in the latest poll, with his second place individual, Governor DeSantis, not so near at 16%, it does look like this is a done and dusted primary. But when you look a little bit closer into the polls and some of the other questions that are being asked in key places like Iowa, you do see that there is a path for someone to potentially emerge.
AMH unions, just quickly, they're getting pay rises big time. American Airlines, UPS. Anne-Marie, is that in the president's favour?
It is in the president's favor because he wants to campaign on being a pro-union president, and he can then look back and say, look at what unions are doing. I was correct. But, Jonathan, this is going to be a tricky month for the president up until September 14th, where we could potentially see a strike of auto workers. And today is a really important day because the UAW will vote today. Workers will vote today whether or not to give that leverage to their president to put a strike on the table. And they are asking for a lot. And they've even touted that this EV electric push, which is coming from the Biden administration, they say Washington, D.C. needs to know that this is not hitting the right nerve with our workers.
Interesting. AMH, thank you. Down in Washington. Elisa, you said this morning. We've had the pay rises without the strikes. So far, so good for this White House. As Anne-Marie just suggested, that can change quickly.
UAW asking some pretty aggressive things, and they are looking to really shut down some of the emphasis on electric vehicles that seems to be propagated more broadly from the administration and globally. It could be more of a clash. They're having some pretty big asks, and this is really a concern. Something like $1 billion in extra costs a year for each of the major
it's real money.
automakers. Yeah, it's
real money for the airlines as well, by the way.
Yeah, so where does it come from? But also the fact that they realize they need their workers more than they do the money. And that's the shift.
We've got a tight labour market, unemployment near 3.5%, and we've got tight monetary policy, we're told, apparently, with yields near multi-decade highs. Kennedy Goldberg of TD Securities is going to join us on that a little bit later. And we're going to talk about this, the prospect of a major IPO in the United States of America. Your top three all time for tech IPOs in America: Alibaba, $25 billion, Meta, $16 billion, Uber at $8.1. Arm is looking to raise $10 billion US. It's pretty amazing. I keep going back to it. We're talking about tight monetary policy, supposedly, and at the same time, we've got basically one of the biggest IPOs in much of the last decade.
It's the reason a lot of people think that maybe this is not a restrictive policy. On the flip side, Arm is not Birkenstock. It's not Instacart. It's a pretty established, behemoth. So there are differences. I'm curious how much it can be a parallel and how much it's an example of the artificial
Arm is not
intelligence.
Birkenstock. Value add this morning. Do you want more value add? This from TK. True story, apparently. Lagarde was a member of the French national synchronized swimming team as a teenager. Apparently that's a true story. Available on Wikipedia. There you go. Equities doing okay on the S&P 500, positive here by 0.4%. We have a lift on the S&P, on the Nasdaq as well, attempting to deliver a second day of gains on the Nasdaq 100, positive here by 0.6%, trimming the month-to-date loss to about 5% on the Nasdaq and 4% on the S&P 500, respectively. That's the equity market. In the bond market, shaping up as follows: a 2-year, 10-year, 30-year looking like this, just south of 5% on a 2-year after closing with a 5 handle for the first time since the collapse of SVB. In the bond market, a new cycle high for the 10-year, 435. Right now, 431.81 with yields lower by a couple of basis points. On a 30-year, levels we haven't seen in more than a decade, Lisa. You've got to go back to 2011 to have a look at 442.68.
It's just shocking, some of the levels that we're reaching, and people are trying to buy and then not so much. I mean, just to look at the slowly losing steam of the Treasury rally of the earlier morning highlights how much people are concerned about Katie Kaminsky's 6% Treasury yield, not call, but projection outward based on the technicals.
Not a call. Just be very clear about that. But she was dead on at the start of this year, leaning aggressively into that short on Treasuries. We have got the dominant factor in the FX market being US real yields, positive and climbing over the last month. That means dollar strength. Take a look at the euro. The euro negative by, let's call it 0.1%, 108.84. Lisa, that's the story. It's got to be, right? Positive real yields, dollar stronger, euro in a world of trouble. What happened to 115, 120? Those calls from a month or so ago.
It's everything on its head. You have the US doing better than expected, potentially raising rates yet again. Everyone thought that the ECB was going to raise rates more this cycle. You have Europe suffering more from the slowdown in China that's accelerating, even though it was supposed to be really seeing some momentum pick up because of the reopening. And now you've got real yields. At a certain point, you have to wonder at what point is this going to be self-fulfilling, where the dollar keeps gaining, even as we get higher prices in oil and everything else.
Everything else, all of the above.
Everything, yeah.
Nothing boring about this. Under surveillance this morning, look at Chinese equities. Look at the Hang Seng. The Hang Seng, the chart is unbelievable. In just a couple of minutes, we rallied a couple of percentage points, seemingly out of nowhere, heading into the close. And obviously, Lisa, that move is fueling speculation about what's behind it.
Clearly, it's just people just saying, all right, now it's time to buy. No, I'm just kidding. It's what everyone thinks is that the State Plunge Protection Patrol came in and started to hoover up a lot of stocks. I mean, they're trying to give polite guidance to investors, polite guidance to banks saying, please, maybe don't, sell as much as you buy and stuff like that. It's not working. So probably people thinking maybe they're taking matters into their own hands. At what point do they have real solutions versus cosmetic shifts to try to control the narrative and the speed of some of the losses that we're seeing?
Control the optics. What about the substance? I've mentioned this quote from BHP a million times. If you want insight into China and you can't get much clarity, you can't do much better than hearing from a miner, the world's biggest miner. And this quote from BHP Billiton, I think, sums it up pretty well. Policies have been put in place that are meant to stimulate new starts in the property sector. We're not seeing that translate as effectively into changes on the ground as we were anticipating. That is overwhelmingly the view right now. They've done all of these little tweaks. We thought they'd deliver something. They haven't delivered anything at all. They've reopened the economy. We thought it would lead to a boom. Consensus view. Well, there's pushback, I know, but that was the consensus view. It hasn't delivered that boom at all.
So unwilling or unable? And that's what people are wondering. Is this an administration, Xi Jinping, who is unwilling to really expend the capital to do this, or unable to really stave off some of these declines because they're pushing on a string with efforts that could undermine the financial sector if they were too aggressive on certain points?
The first thing we all look at the moment, every single morning, waking up stateside. Here's another one for you. S&P following Moody's in cutting their outlook for a number of US banks, citing a tough climate for lenders. S&P also lowering their grades for a number of smaller banks, including KeyCorp and Comerica. And they write this might sound familiar. The decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Lisa, you could have written that in March, April, May, June, July. In fact, you could have written in January, February, for that matter as well.
The distinction here is back in March, people were wondering, does this mean that they're going to stop lending altogether, go out of business, and suddenly we face a credit crisis that's going to really torpedo the economy and make the Fed's job easier? The answer was no, none of the above, didn't happen. And now you have S&P following Moody's to raise questions around profitability. It is a different question than a question around ability to lend, willingness to lend, and something that matters to the economy on a broader scale. That's the shift in tone. It hurts them, but not everybody else.
If you heard those first two stories, things would sound terrible. And then you hear about this. SoftBank's arm filing for an IPO on the NASDAQ in what would be the largest tech offering since Alibaba in 2014. What does that tell you, Lisa? Things sound terrible when you talk about the banks, about China, about restrictive monetary policy, and then we're staring down the barrel of one of the biggest IPOs in the last decade.
We're seeing risk markets hang in there and then some. Anything that has to do with the tech sector, especially, people expecting to be enthusiastic for this. This was a company that NVIDIA had wanted to buy before SoftBank. SoftBank's retaining a bigger than expected chunk of it. Does this say something about the IPO market, or does this say something about the enthusiasm for tech, or both, right? I mean, how much are we trying to parse through two narratives that really are united, with the tech hopes and dreams fueling the sense that everyone can look past higher yields?
I will say most IPOs are unique. This one is particularly unique. I've known that management, the former management, for a long time. Well-established company that was listed in London, taken off London, taken in by SoftBank, relisted. I don't know how much you can learn from Arm because of that, Lisa. It's not like this startup that's come out of nowhere in the last couple of years.
It's a deeply proven company with a hefty footprint in all things smartphones. It's unclear that that's really going to be an example of what's going to happen with Instacart and Birkenstock.
Birkenstock. The one to watch later this year, maybe.
Definitely.
Joining us on Fixed Income, Gennady Goldberg, the head of US rate strategy at TD Securities. Gennady, good to see you, sir.
Thanks for having me.
What are you more surprised at since the failure of SBB? The fact we've got a 2-year yield back at 5% or the 10-year going back through 4.30?
I think the 2-year back at basically 5%. I think that's the pain trade for a lot of the banks. I mean, you were mentioning things that have slipped from the headlines. I mean, talk about banking pressures, right? We still continue to have banking losses all over the place. And you'll see that once the aggregated Q2 numbers are out. You'll see it in Q3 as well. I mean, if you just track unrealized held to maturity and available for sale losses at banks, the pressure's on. And especially as we head into the fall, it is going to be very interesting to see what happens on the banking side and whether that creates a new round of pressure as we head into the fall.
It's interesting to me that you see the front end as being more surprising than the long end. Are you saying that yields at 4.3% on a 10-year make sense to you and are sustainable?
Sustainable for how long? I guess that's the big question. And the question that I'm asking myself is, how high can rates go before it becomes almost self-limiting, before these real interest rates really start to weigh on the economy, and that actually starts to drive us in the other direction? At what point does the economy effectively break under the weight of real rates? I don't think we're quite there yet at 4.3%. Maybe a little bit higher than that. But I still think that the market's ignoring a lot of this interest rate pass-through at their own peril.
We heard this from Russ Kostridge, too. There is a level. We're not there yet. There is a level. How do you even determine how to look for that level at a time when people seem to be looking past this? And yesterday, even tech stocks rallied. NVIDIA was up more than 8% at a time where Treasury yields were hitting the highest levels going back to 2007.
So I'm always a little bit cautious about giving too much credence to what happens in August. Markets are thin. Not to insult the folks who are still on the desks, but markets are quite thin. I can tell you the level of confidence from a lot of the investors is very low. So you haven't really seen very confident investors actually investing in treasuries. They're still waiting for that kind of, that tipping point. They're wondering what that point is, where they're no longer going to be losing money on their interest rate holdings. So, folks are trying to dip their toes. Like you said, they're getting burned, unfortunately, every single day. There's going to be a point where a lot of folks will want to jump in. The question is that enough, or is that a high enough point where the economy breaks and we start to move back the other way? Right now, it doesn't seem like it, but interest rate pass-through is long and variable, unfortunately, just like the Fed's lag. So it's going to take some time for that to show up.
These yields were the stuff of dreams 3 years ago. I want to keep, really hammering on about that. This was the stuff of dreams 3 years ago. And now we're trying to work out, is it the stuff of dreams or the stuff of nightmares? And you touched on it, and I think it's a really important way of looking at things right now. It's highly dependent on how you frame this move. Do you see this move as a reflection of an extension of the cycle or the recipe for the end of one? How do you frame it?
I think it's the latter. I think the higher rates move, the more likely you are to have the cycle end. Now, the question is that level 2% in 5-year real rates? Is it 3% in 5-year real rates? Or is it even higher than that? I mean, you mentioned it. If you look at 5-year real rates on a 15-year basis, these are the highest levels we've seen. Now, if you look at it on a 20 to 30-year basis, we're about halfway through the range. So maybe we're seeing just a normalization of policy. And, by that point, we'll actually start to, that'll start to weigh on the economy.
Well, you've got to make a risk assessment, and you've got to give me one. Is it highly balanced, asymmetric? Do I want to buy this 10-year right here at 430 or wait?
I think you want to start dipping your toes here. And I think that's been the sentiment from a lot of investors. Unfortunately, it's the next 3 to 6 months that everyone's worried about. It's not so much 12 to 18 months. I would say if you ask most investors 12 to 18 months from now, they are expecting the economy to slow. But 3 to 6 months from now, that's the big fear, is that can we hit something like 5%?
Just quickly, at what point are higher rates like this stimulative more than they are restrictive?
Stimulative for a lot of the lending, certainly. I mean, you do have a lot of investors trying to put their cash into, certainly all sorts of new places. But, just look at what's happening on the money market side. Cash has value once again. And it's the first time in really 20 years that we've had cash have value. Folks can just put their money in a, 3 or 6 month T-bill at 5.5%. Why invest in corporates? Why invest in equities? There's a lot of money that's going to be getting sucked out of the system. And I think it's ongoing right now. There's a point where that's going to start to actually weigh on the economy. I just don't think we've quite hit it yet.
Kennedy, good to see you. Thanks for being with us. Kennedy Goldberg there of TD Securities. You're really pushing that point, aren't you? The prospect that maybe this is starting to become stimulative.
Yes, because if you think about it, if you're getting money for your cash and there's so much liquidity sloshing around, maybe it's come out of Bitcoin, maybe it's come out of unprofitable tech, maybe it's come out of, non-fungible tokens, which for a hot second my son was interested in. There is a question around, okay, yeah, maybe that goes into cash, but there still is plenty to go into stocks, and there's still plenty to go into everything else. So then on the margins, if you're making money off your money, then that's going to give you money, right? You can do something with that.
Who is you? And who has a higher marginal propensity to spend? People with tons of cash or people without much cash at all?
That's a good point.
The timeline's different. So if you look at the UK right now, the interest on savings, of course, that amount of money has gone up loads. But those people don't have a higher marginal propensity to spend. If you think about what's going to happen over the next 12 months with mortgage costs, particularly in the UK, different structure, of course, the people who don't have all of that cash, getting all of those savings, they've got to pay up big time over the next 12 months in interest costs on their mortgage. And those individuals arguably have a higher marginal propensity to spend. So the difference you're going to make on the economy is going to be much, much higher over the next 12 months when you start to see this eat into the people that are carrying a lot of debt, particularly in the mortgage market.
It's a great point, especially as people think about at what point the savings are going to run out. It's for a specific subset of the population that we're talking about most importantly of all.
This is why this argument still stands. You might think monetary policy isn't restrictive now, but wait here, which is arguably, I think, the conversation the Federal Reserve's trying to have going into Jackson Hole. If you're just tuning in, welcome to the programme. The S&P 500 positive here by 0.5%. Coming up in about an hour from now, 50 minutes from now, a man who knows way more about this stuff than any of us do. Vincent Reinhart of Dreyfus and Madden. Lisa, going into that Jackson Hole speech with Chairman Powell just a few days away.
I'm curious to hear whether he agrees with the likes of Jason Furman, who call for a reassessment of a 3% target for inflation versus the 2% traditional target, and whether that's acceptable, whether that starts to leave this feeling that, okay, well, then what's to stop them from kicking it up to 4% or 3.5%? How do you control it if you feel like it's a moving target?
Chuck Grom of Gordon Haskett joining us as well on retail earnings in about 5 minutes from now. What did he call it, Lisa, a few weeks ago? He called it a discretionary recession. Wasn't that what he was calling for?
And that seems to not be happening quite yet, unless you're working for Dick's Sporting Goods, because that seems to be somewhat difficult. But that had been hopping for
specifically
quite a while.
The retailers, I think. You seeing that show up at Walmart, the trade downs, Target, a little bit of difficulty in certain places?
Yeah. Although, that's what they say. And then you look at the results and you parse through line by line. There still is enough discretionary spending. You look at the S&P 500 discretionary stocks.
Yeah.
They're up 27% so far this year, something like that. I mean, this isn't exactly forecasting recession.
I hear you. The new excuse, student loan repayments. We heard that from Target, from Walmart. We'll have that conversation in just a moment. Live from New York City this morning. Good morning to you all.
The consumer has been solid. We're seeing a potential shift from services spending doing really well to now, goods spending has been starting to turn a bit. Consumer discretionary is more exposed to goods spending. And I think, positioning when we've looked at, fund manager holdings of consumer discretionary stocks is at extreme lows.
Jill Carey-Hall of Bank of America with us on the last hour, upgrading consumer discretionary. And that's been a surprise of the year, and she thinks it will continue to surprise. If you are just tuning in, your equity market is leading the way, gaining by about 0.5% on the S&P 500, near session highs and potentially delivering a second day of gains. In the bond market, yields still near multi-decade highs, the 2-year pulling back by not even a basis point. Lisa, you made this point. This bond market rally this morning is fading, isn't it, over the last couple of hours? At the moment, your 10-year down by something like 3 basis points. It was lower than that. We're back to 4.31 on a 10-year yield this morning.
Katie Kaminsky finally has company with the bond bears really seeming to gain some steam. All the people saying that they want to buy, the screaming buy. Where is that conviction at when day after day, as we just heard, they just get absolutely burned day after day?
30 basis points intraday on a 10-year back in March 2020. If I'd said, Lisa, I'll give you 400 basis points more than that, 4 percentage points more than that, just wait 3 years. You'd be like, promise? I'd be like, absolutely, it's all yours. And then you get here. This is what I love about markets. You get there and then people are like, it's the only place in the world, I think, where there is a sale and people run away from it. If there's a sale anywhere else in a market economy, people kind of run towards it. With this, it's completely different. It's the psychology of markets that always entertains me.
With a T-shirt, the risk of maybe getting something of lesser value is not that great. With the market, people are all worried about what they don't know. Is this truly a regime change? Are we going to get to 6%? Because then this doesn't look like a bargain. This looks like a time to run and to sell screamingly, because things are still going to get worse in terms of bond prices down, yields up. So these are some of the questions, the existential questions that people are asking ahead of Jackson.
Let's talk retail. Chuck Grom joins us now, senior retail analyst over at Gordon Haskett. Chuck, you named it. You came out with that phrase in the last couple of months on this program. You said discretionary recession. Are you seeing signs of that from the earnings we've seen this morning?
Yeah, I mean, generally speaking, almost everybody's comping negative. And I think, you can go back to last week's Target report and you look at the big bellwethers between Walmart and Target. And, Walmart, who sells a lot more food, business was really strong. And Target, whose business is more discretionary in nature, continues to be really soft. But I think, as you guys know, the market's forward looking. And I think we're starting to see some signs of stabilization in discretionary as service spending, we think, is starting to plateau. We're seeing some signs in home furnishings that certain parts of the business are starting to stabilize. We heard from TJ and Ross last week, Wayfair earlier in August. So, we'll see. But there's a lot of mixed data points out there today.
Let's talk about some of the specifics that have come out. Macy's in particular evidently first saw a bit of a pop as they reaffirmed guidance, and then now shares are lower as they're looking at markdowns being insufficient to clear inventory. Is there any larger story to tell here about price tolerance, about the middle tier retailers and how tough it is for them to really move their materials?
Well, no, I think the bottom line for Macy's is that, some parts of their banners were really good. And I think generally speaking, inventory levels across retail continue to be really healthy. But there's definitely weakness across certain parts of retail. There's no really size fits all right now. We continue to watch the trend. And, we'll see how some of the data points come out. Like a company like Lowe's, whose numbers are actually a lot better than expected today. You wouldn't expect to see that with rates moving higher, but their business continues to be really healthy.
Yeah, well, people are renovating their homes rather than moving out because they want to keep their mortgage rates at 3% or whatever. I do want to talk about Dick's Sporting Goods. Shares plunging after they missed their forecast. Talking about theft as one of the biggest reasons. How much more have we heard about theft among all the retailers, particularly over the past 2 years?
It is an issue that is not getting any better. And the problem is retailers can't price to it right away. And that's where the margin surprise comes from. Everybody's talking about it. Target's talked about it. Home Depot has cited it, and even Dick's. But Dick's issue today wasn't necessarily because of theft. Their same-store sales were below plan, and really for the first time since the pandemic, they kind of put up a foul ball for them.
At this point, we're looking at a situation where people are expecting discretionary spending to run out. Is there an area of the market where we're seeing this, or are we just not seeing this? And do you view some of the warnings that we've heard from Walmart CEO and Target CEOs as simply trying to lower the bar so they have an easier time crossing it later?
That's a good question. One of the things that we're starting to see, and we heard it in Macy's report today, and Target called about it last week, was a rise in delinquencies in their credit card businesses. And that's something we really need to keep an eye on. We have not heard that in several years, and we're starting to hear it today. Again, like I said, Macy's credit income was much weaker. So we're seeing some cracks in the consumer, but broadly speaking, we still are pretty upbeat. When you look at real wage growth, 3 consecutive months of positive real wage growth, we haven't seen that in years. We actually think back to school could be really healthy. The weather is certainly breaking across the country like you'd expect to see. Balance sheets for the consumer are in really good shape. So we're more optimistic than we were 3 months ago. I know we talked about that discretionary recession. It's really, really company specific right now.
Chuck, the new blame game, there's a ready-made excuse in the oven from Target and Walmart. Lisa's talked about it a million times. Student loan repayments. Who does that affect more?
It'll affect more the Targets of the world than Walmart. I mean, anybody who has a student loan tends to have, a household income of $75,000 or above. So it's gonna be an issue. I don't think it's a huge issue. Again, we come back to real wage growth offsetting a lot of those student loan repayments. But at the end of the day, people who haven't been paying a student loan are going to be. It's a net negative at the end of the day.
When you talk about the fact that we are seeing people shift from services back to goods, which goods are getting the biggest pop from that? Is it the idea of investing in your home because you're not moving? Is it clothes? Are there areas you're looking at?
Yeah, it's a great question. We follow Costco, and Costco gives monthly comps. And so you get a really good snapshot on the consumer in certain parts of their business. We're starting to see that stabilization in consumer electronics. We're starting to see it in home furnishings. And when I say stabilization, I mean, we're not seeing declines. We're seeing sort of, flat levels on unit volumes. And we'll continue to see, like I said, the consumer has money, consumer has jobs, so they're willing to spend. And if we see services start to pull back, we think when people are spending more time in their home, they'll continue to invest in their home. And that's an area that we think could continue. And you see, again, like numbers like Home Depot last week, stabilization. Lowe's numbers today were actually pretty healthy relative to expectations. Home furnishings, you're starting to see signs of it. So I think that's what the market wants to start to look for.
Chuck, sounded a bit more constructive. Thank you, sir. Chuck Grom there of Gordon Haskett. Quite a change. Just a little bit of a change there, at least from the mood from Chuck, compared to, say, maybe a few months ago when we were talking about consumer discretionary. Just a little bit better on the margin.
Join the club. I mean, this seems to be what everyone's feeling right now. Everyone expected, as you said earlier, everyone expected the savings to be over, last quarter, the quarter before that, and this quarter. And it isn't. It's still there. And so at what point do you start to say there's some kind of fulfilling kind of structure here, whether it's higher wages, whether it's less inflation that's letting people continue to spend?
Look, you've asked the question as to whether higher interest rates are stimulative, and I think you're right to ask it, by the way. I think you are. My example is very specific to the United Kingdom. For the UK specifically, whether that carries as much weight here in the United States, I'm not so sure. I think it's a question we've got to ask going into year end.
But, that said, you raise a really good point that who's going to benefit from these higher rates? It's people who are savers, people who have discretionary spending, and those people typically are not the ones who end up spending the most, right? Who aren't going to spend on the margins because they're earning an extra a couple $1,000s from their savings. So that's really the conundrum. At what point is this just, as we were hearing, just simply long and variable lags?
Super long ones.
Super long.
Super long. Monica DeCento of JP Morgan's going to join us shortly. Here's a line from her. Use the coming months and any volatility that comes with it to add to equity risk in portfolios. Monica is going to add to that, Lisa, in about 5 minutes' time.
Again, she's not alone. We heard that from Jill Carey Hall. We heard that from so many different investors saying that there still is a lot of upside, which is a reason why we've seen stocks hang in there despite yields where they are. I mean, again, can you think about 2 years ago, you say that the yield on the 10-year would be 4.3%.
Laughed out the room.
And then that stocks would be rallying. Tech stocks.
Laughed out the room.
Yeah.
If you'd said 9 months ago tech would be where it was, even with this correction, you'd be laughed out the room. There's been a lot of surprises this year. I would say the biggest surprise has just been the growth profile of the US relative to what we've had from China. The fact you've had significant upside surprises in the US, coupled with significant downside surprises in China when we thought the economies would be going in completely the opposite direction. We are discussing stimulus in China and the prospect of tighter policy in the US. At the start of the year, we were talking about cutting interest rates at the Federal Reserve. Remember that?
Yeah, I mean, honestly.
By the middle to the end of this year.
now. We were supposed to be cutting rates now, at
Amazing.
least back in March. And now, maybe not until 2025.
Chairman Powell and Jackson Hole, days away. Your equity market positive by 0.5%. Live from New York, this is Bloomberg.
This isn't yet about any kind of growth slowdown.
We're likely to have a very mild downturn early next year.
Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
We are expecting this higher for longer cost of capital environment.
We might be in and continue to be in a higher interest rate environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We are counting you down to Chairman Powell this Friday in Jackson Hole, Wyoming. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market trying to build on the gains of yesterday for a second day of gains on the S&P 500, snapping that 4-day losing streak. The main event, though, in the bond market, Lisa. Yields we haven't seen since 2007 on a 10-year, since 2011 on a 30-year.
And you put those two stories together, and what do you get? People shrugging off higher yields and saying that they can be managed in an economy that is driven by artificial intelligence and all sorts of other hopes and dreams, as well as people who are not running out of cash to keep spending to improve their homes and to buy things at Macy's.
Who you describing?
I'm just saying. I mean, that's basically what the story of this morning has been. Consumer discretionary spending still hanging in there, much more than people expected.
Yep.
Yields trying to go down, not really succeeding as much as people would hope. And stocks continuing to tear upward, in particular the tech names.
So what is Chairman Powell's job this Friday at 10:05 Eastern Time? Andrew Hollenhorst, the City, publishing in the last hour. Here's the top line for you. Powell is unlikely to push back against higher yields. Lisa, at this point, given where the data is, why would he?
100%. This is exactly what they've been wanting. I mean, this is what we heard from Claudia Sahm yesterday. What took you so long? This is what we've been saying for so long. And at this point, this is sort of what people were expecting. Is this what it takes for people to actually believe the Fed that they're going to keep rates higher, to get longer term yields high enough to be restrictive for them then to fall back down? I mean, literally, this sounds crazy, but this is how some people are gaming it out. They need to stay high for long enough for the long and variable lags to actually take effect.
To actually start to bite.
Exactly.
Because they're super long. Is Chairman Powell going to endorse these moves on Friday? Possibly. People are asking for more. Tell me about the long dot, the neutral rate. Explain why it's higher from here. Is he really going to go into that conversation this Friday, given that John Williams, his right-hand man at the New York Fed, has basically poured cold water over that in the last couple of weeks anyway?
And basically talked about the idea of cutting rates going forward.
In 24.
In 24, just because on a natural level, if growth slows, if it slows, and it's actually suddenly a big if, then, you know, rates where they are is much more restrictive than where they are right now, given the growth where it is. I don't know how much he's going to get into any of this, even though the title of the affair is about structural shifts in the global economy. You can say whatever you like.
Come on.
You could say, but are there structural shifts? I mean, that's the key question. Is this time different? Are we in a new higher inflation, higher rate paradigm that requires a different Fed response?
12 months ago, we knew what he would talk about. We just didn't know how he'd do it. 8 minutes, 9 minutes, sort of down the barrel, really aggressive, pain, lots of pain. Where's the pain? Been asking that question. This time around, it's kind of unknown, right? Going into September, whether they'll hike much more after that. What can he say beyond what we've already been told?
I think it's a good point. Some people think he'll just cue really close to the minutes. People are going to be looking for any kind of guidance that they're going to allow inflation to run hotter for longer. We've already gotten that. They're talking about inflation above 2% for a substantial period of time. And that, if they could lean into that, will be interesting.
Equities right now on the S&P 500 near session highs up by 0.6%. The yield of dreams, according to Gargi Chowdhury over at BlackRock. I'll catch up with Gargi a little bit later this morning and see if she's still dreaming about high yields from here or whether this is sufficient. 431 on a US 10-year yield, a little bit lower by a couple of basis points. In studio with us here in New York, I'm happy to say, Monica DiCenzo, the head of global investment opportunities over at JP Morgan. Monica, good morning to you.
Morning.
It's good to see you.
Likewise.
Is this dip a buy in this equity market for you?
It is. It obviously depends where you're coming from. And I think a lot of people I work with started the year being very bearish, waiting for a dip. And then 20% later, they realize they missed it. So now you're down a few percent. So I think if you are under allocated to equities, which most clients I work with are, yes, you should be adding a little bit.
The call at the halfway
you're going
point of the
into
year,
some bumps probably into your end.
as you're aware, was start buying stocks for the people that missed it. The argument they were making was it's going to broaden out. Go to the equal weight S&P 500.
Yeah.
Look at the things that have lagged. Is that your argument now?
I think you need to be careful going too heavy into tech, even though it is still performing well. And we'll see what NVIDIA does this week and whether that still continues. Because most people I work with had too much tech last year, probably still had too much coming into this year, and they do need to broaden out their exposure for the next cycle. Doesn't mean you can't still see tech work, because if growth is there, there's a secular story there, and that's why semis and all that look very interesting here.
We heard this from Russ Kosterich. We heard this from a host of other people. At some point, higher yields will bite, but not yet. So what are you looking for the higher yields to matter, to sort of throw you off course?
Well, I would argue they did matter last year. It was the pace of the move in yields last year that spooked people, especially growth, especially tech. Now that pace is moderating. So the absolute level matters, but I think a sharp move higher would be what you see bite tech and growth again in a meaningful way. Now, longer term, that's going to weigh on valuations. And so you do need earnings growth to be able to sustain valuations here if rates stay here.
Okay, sharp rise. I want to define that, because right now I'm looking at an increase of about 0.5%,
50 bips in a month.
50 bips. I mean, this is a pretty significant move, right? How significant is significant?
Yeah, I mean, what we saw last year, clearly given expectations, last year was very significant. So this is significant, but now the expectation is we hang in here, maybe one more hike. And so with that sort of backdrop, I think the outlook is a little more moderated. And that's why you can be a little more comfortable owning equities. To be sure, though, there is a lag effect. We've been talking about that. That probably still hasn't hit the market. And so that's why, yes, I'd add a little here, but you have to expect volatility going into year end. And so you think of things like low volatility overall in the market. It's a great time if you have equity exposure, instead of selling, to think about hedging, or to use that volatility as we get to later this year to add a little more. And I would leg in maybe a quarter now, and then if you had to add that 100% or $100, you add in like 25 increments over the next 6 months.
Help us out on the fixed income side. A lot of people listening sat in cash, maybe took on some T-bills, 5% start of the year. That was great advice. They're looking at now at yields they haven't seen since 2007 on a 10-year maturity, further out along the curve on 30s, yields we haven't seen since 2011. What do you suggest those people should do? Just sit there in money market funds still, or go out along the curve, look at a 10-year?
I think you need to go out along the curve. Again, I don't think the Fed is done. I think we're in a higher rate for longer regime. And so with that backdrop, you need to be thoughtful. Most of my clients don't have enough fixed income, so they should be adding. But if you're worried about what the Fed might do, and if we're not at the end, look to places like emerging markets, where they're already through a central bank cycle. And there you can add a little bit of fixed income. You get that yield buffer, even if spreads widen a bit more. And so that's kind of an interesting way to balance that. I'd add some in the U.S. than some in EM.
Every week on Surveillance, we kind of track the roller coaster that is sentiment and the narrative that is shifting from one to the other, swinging rapidly between no landing, soft landing, hard landing, what landing, et cetera. Now, I'm wondering from your clients, is there more fear than greed, or greed than fear? It is shocking how sentiment has changed this year. Now, while sentiment has changed, we haven't seen the money follow it. The money is still sitting in cash. Everyone's still waiting because they feel frustrated by not seeing a more significant pullback. But it does seem very clear to me when you look at this market, soft landing is consensus now. And so if you don't share that view, then you have to be positioned for something other than that. I still think you're going to have pockets of volatility. Those air pockets in the equity market will give you chances to keep adding. But I will say the market's telling you that they expect a soft landing. And so you should be positioned for that in your portfolio. What is a soft landing that would allow this rally, that would allow this market to continue at pace, given how consensus it's become?
Yeah, I think you need to see earnings actually hold in next year to support. We're looking for 8 to 10% upside in equities. That's not predicated on a multiple expansion significantly. So if you don't see earnings hold in into next year, there's risk to that. That's why this July quarter has been so interesting, because it's actually been pretty good. And so we've seen numbers come in fairly strong in the last week. That's given people confidence. I think that's why you're seeing equities hold up now after this dip. But we got to see how that plays out over the next couple of quarters. Again, it's why you want more ballast. You don't want to be all in equities, because you need that insurance, that insulation in a portfolio.
There's some expectation that Chairman Powell might say something significant on Friday. I wonder whether that's just because it's at Jackson Hole in Wyoming. If it wasn't at Jackson Hole, would you expect anything at all from Chairman Powell Friday?
I don't know why you would. You're saying you're data dependent. We have more data coming in the next few weeks. Why? I don't understand. I don't think the incentive is there. And so I would think you stick similar to what you heard in the minutes and hang in and watch that data and go from there. I just don't see the incentive to be that bold. It'd be exciting for us, but I'm not sure that's
the bias, isn't it? Lisa, I think everyone wants something exciting.
Yeah,
totally. When you strip it all back, Lisa, you just wonder, what's the incentive to say anything new on Friday?
There is none, except maybe to take leadership globally, especially with all the other central bankers there.
Possibly. Is Lagarde on the same page as him on certain issues?
Are they on the same page with themselves from week to week, right? I mean, at what point are they looking at data with some kind of comprehensive view? of what it means and what they're looking for.
Can I ask an unfair question, Monica? When
Sure.
they say they're data dependent between meetings, what do you think that means?
Listen, I think they want to see continued proof that this increase in rates is having an effect on the economy. And so they want to see more information coming in the next few weeks. But again, I think it's this tricky balance of you want to do enough to get where they need to go in inflation, but not so much that you break everything. And that's, by the way, an incredibly hard thing to balance. And so that's why me and many other people say, you have to expect volatility. This never is going to end perfectly. And I think if you expect that, you're dreaming.
Monica, this was great. It's good to see you.
Thanks.
Monica DiCenzo there of JP Morgan. We heard something similar to Kelsey Barrow. Do you remember what Kelsey said from JP Morgan earlier this week? It's always at this point towards the end of the hiking cycle, people start talking about soft landings. I think she went back to a Bloomberg Business Week story that had been written about, landing, a soft landing in early 2000 or something like that. It's almost verbatim the conversations we've had time and time again at this point.
It's like spinning around really, really, really fast and then not feeling it until you stop. And then you're just
feel really dizzy.
Yeah. I mean, it's sort of, there's a question of, okay, if you hike rates to this point and then you get to the end, is like when you get to the end is when you can actually understand just what the effects are. That said, I mean, at what point do people get exhausted by all the gloom and doom that some people have been propagating out there that could potentially be
some people
that have been wrong.
Some people. Just to confirm,
wrong.
Lisa, we've found where Mr. Barkin is over at the Richmond Fed. I understand he's speaking at the Pennsylvania County Chamber of Commerce. And we'll take audience questions.
Yeah.
All right.
And he also said that if the U.S. has a recession, it would likely be a less severe one. So kind of leaning into the whole soft landing, that even if there is a recession, it's going to be a little less painful.
He's raised the question as to whether we are sufficiently restrictive.
Yeah.
President Barkin has. That's the right question, I think, going into Jackson Hole. You've asked that question too. It's an important one.
You did too. And there's a question if people are, this ARM IPO, if it goes really well, and if companies are able to refinance, and is this a restrictive market, or is this sufficient because it's fine?
Vince Reinhardt joining us a little bit later this morning of Dreyfus and Mellon. He'll join us in about 20 minutes' time. If you're just tuning in, welcome to the programme. The S&P 500 positive here by 0.6%. We're light on economic data over the next couple of days. But Lisa, after Chairman Powell speaks, within a week, you'll get payrolls. A couple of weeks after that, you're going to get a CPI report in America.
I'm glad that you asked about data dependency and the meaning of it. I keep wanting to go back to this because what's our threshold for what's good, right? At a certain point, are we just looking at a market that is strong and a Federal Reserve that doesn't really want to go against the grain, especially in an election year? And I'm not saying that they're being political, but if inflation is going down, they're focused less on the pace of how quickly the inflation is going down and where it's going to, and more on it's kind of going in the right place. So then do we really need to do more?
They want to avoid the accusation of being political, which introduces the political conversation. It's unavoidable, isn't it?
It's unavoidable. It's
always
unavoidable. Exactly.
In election year. The look of cutting interest rates going into the election next year.
At what point?
It's not great optics, is it?
No,
it's not. And we know that's something they want to avoid.
There is a concern, and I was reading a report from Citigroup on this, that some of the goods disinflation has stopped. And you're actually starting to see it reaccelerate. There are areas that give some people pause for concern. Curious to hear more granularly what the Fed is looking at that gives them confidence that inflation is going to return to that 2% target. That's the rhetoric they've used. So what data are they going to really get that gives them that conviction? Is it going to be the jobs report? Is it going to be CPI? I don't know.
Neil Dutta of Renmac have not mentioned his name for 2 days or something. That's like a record, isn't it?
It's like one day. Come on, let's not get carried away.
One full day.
It's been a full day.
I think that's the Neil Dutta argument. Anyway, in just a moment, we'll talk about the airlines. Just an unbelievable agreement between the pilots and American Airlines. An unbelievable sum of money, unthinkable several years ago, which speaks to the moment we're at in this labour market. Equities on the S&P 500 positive here by 0.6% on the S&P. There is a lift in the bond market. Yields near multi-decade highs on a 10-year. Yields are lower here by 3 basis points. Your 10-year 4.31.
I think over time, the financial sector does look attractive. You were talking about the underperformance recently. I think in addition to some of the cyclical concerns, it might also be regulation and potential refinancing needs coming from the sector. I think once that settles down, that will be a pretty attractive place to look.
She's one of the best. Just a clinic every time we talk to her on fixed income. It's Amanda Lynham there, the head of macro credit research over at BlackRock. Just to get into the market action for you in the equity market, potentially 2 days of gains on the S&P 500. Equities up here by 0.5 to 0.6% higher. Yields are lower by 3 basis points. Your 10-year 430.82. I was just joking to Bramo in the commercial breaks that on the weekend I'm a UPS driver. In the week now, Lisa, I'm flying an aeroplane for American Airlines.
American Airlines, that's your airline?
I'm going to do some training for that, yeah.
Okay.
Pilots approving a new contract that would provide 46% in cumulative pay rises and a retirement contributions over its 4-year term, along with a bonus, Lisa, improved scheduling, sick leave and insurance benefits. It's pretty impressive.
Well, depending on how things go, you'll be a UAW worker.
Yes, maybe.
In the evenings, you'll build cars.
I'll be making Hummer EVs and all that
Not
stuff.
EVs.
No, just Hummers.
Just Hummers. You'll be making those, and you'll be making bank.
Internal combustion engines.
There is a question, and I keep going back to this. Bespoke Investment Management came out with this point where they basically said it's not that there are strikes that are happening. It's that they aren't happening. That is the interesting thing, that these companies are paying up. I think that American Airlines, something to the tune of $250 million of expenses that are tied annually to some of these increases, and they are swallowing them because the workers are more important than that extra cash.
I would say this too. This, in many ways to me, in certain instances, is the revenge of the labour market. This is a decade of sitting there every single year with your boss and being told, inflation's at 2%, this is your pay rise. Inflation's at 1.5%, this is your pay rise. It's 10 years of that, concluding with this. Hey, what happened to the last 10 years? Every time you sat me down and said X, well, this is what's happening now.
I would take that a step further completely. And then you add to the fact that corporate profits have outpaced labor's share dramatically over the past couple of decades. If you take a look at that gap, it's been really widening. Now suddenly they're saying, wait a second, no, you need us. And you've seen again and again how you need us. So show us how much you need us.
Joining us now is Bloomberg's Mary Schlangenstein. Mary, wonderful to catch up with you. Just an expert on these airlines. You know them inside out. Let's start with this deal. How much is this going to hurt American Airlines?
Well, American had been accruing for the cost of the contract. They did put out a statement this morning saying that it's going to boost their unit costs because there's an extra amount that was agreed to when they renegotiated this tentative agreement that they had. So that's going to increase their unit cost about 2 percentage points this quarter. But for the full year, it's not boosting their unit cost. So they're really in fairly good shape.
Mary, how does this stack up with the agreements you saw over at Delta back in the spring?
Well, Delta reached an agreement first among the major airlines, and their agreement was valued at about $7.2 billion over 4 years. Americans is valued at $9.6 billion, according to the union. And that includes, of course, a lot of quality of life benefits in this contract. So that's not all pay, that's total compensation. Now, Delta does have some provisions in its contract where their pay will kick up if United and American approve contracts that have higher pay. And United hasn't voted on their contract yet. So we'll see. American also has a snap-up proposal on their pay rates.
Just how dire is the pilot shortage right now? Just how difficult is it for some of these airline companies to retain and attract workers?
Well, for the major airlines, they're doing well on pilot supply. The problem they've had recently is pilot training. There are some bottlenecks in pilot training. Where the real shortage is still hitting is on the regional airline level. There are still a lot of regional jets that are parked and aren't being flown because they don't have the pilots to fly them.
And this raises a question about going forward. What's going to happen if there needs to be a longer lag or a longer warning period for some of the pilots before they're called into work? Is this going to increase the cancellations and the delays, or is it going to just have to be covered by a greater number of staffers?
It depends on airline to airline what their provisions are. A lot of the airlines or the pilots groups are negotiating new rules on reserve and reserve pay. That's part of the quality of life issues that they've gone after in this round of contracts. That's one of the reasons, in addition to the raises, that they're so expensive, is they did seek a lot of quality of life improvements.
It's been a decent year to date for some of these stocks. American's still up close to 20%. Mary, as you know well, United up by something like 30%. Delta, a similar move. Mary, can we just talk about the performance of the business at the moment? We've seen some domestic-focused carriers flag maybe a softening of demand, lower ticket prices. How do you think the year ahead is shaping up for some of these bigger airlines?
Well, they're hoping for the domestic-focused ones are really hoping that travel is going to rebound for the winter holidays. They did see a fall off in domestic demand because a lot of people chose this summer to fly internationally. For a lot of people, it was the first summer that they could go internationally. It was the first time that all of the COVID restrictions had been lifted. And so they saw this huge shift to international travel, and that produced record revenues for airlines like American and Delta. And so the domestic-focused airlines are really hoping that for the winter, that rebounds on domestic, people trying to go visit their families again, visit their friends for the holidays. But it's interesting that Frontier Airlines today offered a sale just for today where you could get a free check bag if you fly September 5th through the 30th. And it's pretty interesting that they would offer that for one day. And it makes you wonder, what is their September booking? What is that looking like for them?
Mary, kind of an unfair question, but we're talking about how the staffing levels at American and Delta and the other major airlines are coming into balance as they offer more perks. What about air traffic controllers and concerns around a lack of staffing there? There was a New York Times article yesterday that caught my attention that highlighted at least 46 close encounters or planes almost crashed into each other just last month alone, that these are increasingly apparent and frequent because of the staffing shortages in some of the air traffic controller units. What's the latest? I mean, how much are they remedying that?
Well, there are certain areas of air traffic control, particularly up in the Northeast and also in Florida, where they are shorthanded, and they said they're shorthanded. The other problem is you have a lot of new inexperienced air traffic controllers because just like all the other jobs in the airline industry during the pandemic, a lot of them left. They retired early. They went to other jobs. And it takes several years to train air traffic controllers. So you've got a combination of being shorthanded, then having a certain number of people who are not very experienced, especially for the really busy air traffic control centers. And then, you have people that are still going to be in training for a couple of more years.
What is it about checked luggage? Trying to bargain with us, Bramo. When you get to the gate and clearly you want to carry your luggage with you and they offer to check it for free, as if they're doing you a favour.
Yeah.
And Come to the front and check it for free. What's the incentive for me to check my bag for free when clearly I want to take it as carry-on?
There isn't.
I've never understood it.
Well, how much do people actually check their luggage then? They have to actually just make it so that people can't put their luggage over the overhead.
Right.
This is actually a complete pet peeve of mine because they've created this rush where people now jockey to get in line to be the first on so they can get their luggage into the overhead. And then people swarm the front and everyone's really pushy and it brings out the worst in humanity.
In Delta specifically?
No, I'm just saying
just
in
every
general.
Airline.
I mean, have you seen it in America?
Sure, yeah.
Okay, so there you go.
I hate the rush.
But they've
They
created
forced me to put my suit into my carry-on a few months ago, flying from LA to New York. And I complained and they didn't care. So there you go.
Yeah, well, that's the.
And I'm still flying with them. So what does that tell you? The things we put up with for airlines.
The violin is out. I am playing it.
Play it loud.
Yeah, I'm playing it loud.
Mary, thank you. It's good to hear from you. Mary Schlangenstein there of Bloomberg just knows these airlines so fantastically well. These are big, big deals, Lisa. Delta early in the spring. That sounded big at the time. And now American Airlines was something even bigger.
And UAW up next, United Auto Worker Union, up next with respect to voting on whether or not to authorize a strike. This is, to me, the sleeper story of 2023. And this is the balance of labor shifting back to the workers.
The revenge of the labour market. Coming up on the Open, about 30 minutes from now, we'll catch up with Kirsten Distenfeld of Alliance Bernstein on fixed income, Colin Martin of Charles Schwab, and Gargi Chowdhury of BlackRock around the opening bell. All of that still to come. Live from New York City this morning. Good morning.
About an hour until the opening bell, and if we hold on to the gains that we have seen so far in pre-market trading, it will be day two after a 4-day losing streak on the S&P. We can see up about 0.6%, 44.37 on the S&P 500. Earnings coming in sort of plus or minus this morning, but generally stronger than expected. Dollar strength versus the euro, and the 10-year yield. This is interesting, trying to go down sort of, but just floating back up there as the session grows older, down just 2 basis points, 4.31% after hitting yesterday the highest levels going back to 2007. It's kind of a light week for economic data. Really, the main event is going to be on Friday with the Jackson Hole Symposium. Fed Chair Jay Powell speaking at 10:05 a.m. Eastern, as well as we're going to hear from Christine Lagarde from the ECB. We do get some housing data, though, in particular today at 10 a.m., and it raises this question when we get home sales numbers. Can we call this a rebounding home market if there are no sales, or very few, or if it's anemic? Or is this something that's evidence of an unhealthy trend that's developing under the surface? Joining us now is Drew Redding, home builders analyst for Bloomberg Intelligence. We did get results from Lowe's earlier today, stronger than expected guidance. We get Toll Brothers earnings after the bell. But just, can we call this a rebounding market when sales are stagnating?
Hi, Lisa. Yeah, it's a good question. And we've been describing the U.S. housing market as a tale of two markets. On one hand, you have the resale market where volumes are down more than 30% still from their peak due to greater affordability challenges and a lack of inventory. On the other hand, you've got the new home market, which has been the beneficiary of that, as that lack of inventory we spoke of is actually funneling demand in towards the builders. And builders are also able to leverage their financing arms. So they've been buying down rates. So when you see someone in the resale market paying, 7.5, someone coming into the new home market is looking at 5 to 5.5. But that being said, the broader housing market, as you said, I wouldn't necessarily call it a rebound. I mean, if you look at total sales in the existing home market, which is the biggest part of the housing market and the largest source of competition for the builders, we're at about a rate of 4 million. So we're still down a long ways. I think the thing to point out is we have a situation where volumes are being depressed, but home prices are stabilizing because of that inventory situation.
Just want to pick up on what you're saying, Drew, and sort of push forward to later today when we get the Toll Brothers results. You said that a lot of these home builders are offering rates of 5 and 5.5% to extend their own mortgages to buyers of their homes. Is this essentially the effective rate in the new home sales market, since the other existing homes aren't really moving? Is this basically what's happening, that no one's paying that 7.1235% yield on the 30-year mortgage? No one's actually paying that who's coming into the market right now.
Yeah, so what we've heard from the builders is that a majority of their buyers are leveraging their national rate buy-down programs. And you're right, they're not paying what we're seeing quoted at the market level. That being said, if you look at where rates are now, we checked before we came on this morning, we're up 7.5%. I think the last time we talked last week, we were at 7.25%, and we're up more than 100 basis points since the beginning of April. So while people coming into the new home market are getting a lower rate, that rate too is going to go higher. And I think the concern for people investing in the home building space is going to be at what point the buyers start to balk, and at what point the builders have to kind of lever back up on their use of incentives to keep traffic moving. Because we saw from the latest data from the NAHB that when rates rose, traffic fell pretty sharply. So we think that if rates do sustain at these levels, we're going to see that use of sales incentives come back a little more forcefully.
Just real quick here before we get to our next guest, because this really is the topic of the morning as we see yields go to the highs going back 16 years. How long are the lags? Are we starting to see yields bleed into the housing market in a more concrete way that give you conviction that we're just seeing the start of it rather than already having seen the worst of it?
We've seen a lot of pain in the housing market, particularly in the second half of last year. But we haven't seen the recovery in the existing home market. And that has to do with the fact that rates are so elevated. We have seen a disproportionate benefit, as we mentioned, in the new home market. But broadly speaking, the fact that rates are still elevated doesn't give consumers a whole lot of confidence. And the fact that, we could be heading even higher from here, from 7.5 closer to 8. I think that continues to pressure sales volumes through the remainder of this year and into next year.
Drew Redding of Bloomberg Intelligence, thank you so much for being with us. Really insightful as we parse out, try to understand whether the yields where they're at are sustainable. Vincent Reinhardt's been tracking this for a long time and weighing in on how this economy has been strong but will deteriorate in the face of some of these yields. Chief economist and macro strategist at Dreyfus and Mellon. I wanted to start there, Vincent. Are these yields sustainable where they are right now?
Yeah, they sound easier to explain than when they were sub 2% a few years ago. Inflation is going to settle down at 2%. The term premium or the risk premium that investors are going to pay are going to turn positive instead of negative. And the equilibrium real rate or the natural rate of interest is probably higher given how robust economic activity is. So yeah, it's sustainable. It's particularly sustainable because a key message of Chair Powell at Jackson Hole is going to be the policy rate is going to rest on a high plateau for a while. That's going to feed into longer term yields.
We've been talking all morning about long and variable lags and whether they're very long and very variable or whether they're very short. We've already seen the worst of it. And now the market is adapting and adjusting, to use the phrase frequently used on this show. Which is it?
So it depends on sector. And that is the question for Jackson Hole, by the way. It's about shifts in the economy. From a monetary policy maker, it comes down to the question, what's the transmission of monetary policy? How long are the lags? Answer is sector by sector. That the lagged effect of monetary policy is local, not national. You already went through one segment of the economy where it's shorter, real estate. Home buyers depend critically on mortgage rates. Builders depend critically on marketable rates. So that has borne the brunt of the remarkable Fed tightening a lot sooner than any other areas. Other parts of the economy have a cushion between aggregate demand and monetary policy. Households still have a lot of retained saving from the fiscal largesse they got in 2020 and 2021. They're working it down. As that buffer gets smaller and smaller, you'll see the interest rate effect bite more.
Let's develop on that a little bit more, especially as we get earnings from Macy's and Lowe's and Dick's Sporting Goods this morning, showing a kind of motley picture of where the consumer is and how much savings they have left. What's your sense of the fact that everyone's been saying the savings are running out, the savings are running out? Now they're going to be running out, and they still haven't. Does that make you think that they're not going to run out, or that people just were perhaps a little premature in how quickly they thought they would dry up?
So it probably tells us we didn't appreciate how big the cash load was at the beginning. That is, households saved a lot more of what they got from the government than we expected, and continued to save for a while to come. You know, if you just look at a typical saving rate relative to what households actually were doing, they must have worked down at least a half the cash load. But that's still half. And by the way, we should also remember that states and localities also got fiscal transfers, and they have a cash pile on the sideline as well. And those state governments and localities in particular are the ones that are really very cyclically sensitive. So essentially what the federal government did was lengthen the lags of monetary policy by immunizing, by insulating some of the interest-sensitive parts of our economy to the Fed policy instrument.
This is important, and it really speaks to what could happen if the Fed keeps rates where they are, even if they don't raise them again, but keeps them where they are through the remainder of this year and all of next year, and even potentially into 2025. How long do they have to keep rates where they are to start feeling the bite, to make it so that, you know, it actually has the transmission mechanism that it was intended?
Yeah, there's a couple really important points about that. One is, remember how Chair Powell describes the path for rates. It's how fast you raise them, what level you go to, and then how long you keep them there. We're really at that third stage. How long do they keep them there? And in some sense, it doesn't matter if they raise them an extra quarter point or a half point, or they keep them unchanged. They can compensate by keeping the policy rate there for a longer time. And that's now the strategy of monetary policy. And the longer they keep rates on that plateau, the more effects of the prior increases in rates we're going to see on the economy. So that's the big message to hammer home to investors. They got that the funds rate's going, may go up another quarter point. That's not the important point. The important point is it's not going to be cut nearly as quickly as you might think right now next year. They're keeping rates at a plateau. They're waiting for the lags of the effects of monetary policy to play through. If they're patient and see those lags, they don't have to add incremental restraint because they've got the restraint in the pipeline already.
Just quickly here, do you think that Fed Chair Powell is going to say anything substantive this week?
I think he can tack a little dovish. He doesn't have to talk about pain like he did last year. He just has to be a little more neutral than he came across at his last press conference. He's got markets about where he wants. The main message he's going to want to send is rates are going to be around current levels for a lot longer than you think.
And that seems to be what people are adapting to right now. And the implications for longer term seem to be really kind of giving everyone some angst in terms of what yield is the appropriate yield for the rest of the risk markets. Vincent Reinhart, thank you so much for your insights. We have been looking right now at a 10-year yield that was trying to go down and is now not really going down all that much as people game out what higher inflation and higher rates could look like in the stock market. You are seeing those gains perpetuate, and we have seen them driven in part by the tech shares. NVIDIA shares up more than 8% yesterday, continuing with the gains today ahead of their earnings report tomorrow. If you are just joining the program, S&P futures 44.35, up 0.5%. Coming up, David Rubenstein of the Carlyle Group will be talking about the money management industry at a time of great transition. And there really is this question as we look out to what this new market really is. And I want to bring you this quote from Bill Dudley, the former New York Fed president, who wrote in a Bloomberg op-ed, "I strongly suspect that the bond bull market that began in the early 1980s is over. For the longer term, the steady economic expansion that followed the 2008 financial crisis is no longer relevant. The paradigm has shifted and higher yields are back." Vincent Reinhart, just quick word from you on whether you agree with that kind of assessment. He will be joining us perhaps in Jackson Hole to talk about that. But there is a question around whether that is becoming consensus, that there has been this shift. We heard from Katie Kaminsky that she could game out yields to 6%. There are more people joining her camp. We heard from Russ Kostrich earlier this morning about how he's sort of maybe nibbling at some longer term bonds, but in general sees this as the new reality. The question is just for how long can you see that before you start to see it bleed into earnings and into corporate health. We are seeing from ACEs some concern as you parse through some of the earnings about the consumer, more of that we heard from Walmart and Target in terms of worries about some of the savings running up. We also are hearing from Dick's Sporting Goods that they are going to be cutting some corporate staff members as they try to deal with a situation that's not as positive as it has been. In the markets, we will keep track of those real yields, tracking around 2%. This is Bloomberg.
We look at a 20-year rate of return of 6.8%, so that is our current target. And I'd say over the last 20 years, we've been able to hit that. The last 10 years, we've also been able to exceed that. In the last 5 years, we're just below the 6.8. But over 20 years, as long-term patient investors, we're targeting a 6.8% return.
That was Nicole Musico of CalPERS CIO, and you can watch more of that with David Rubenstein on Bloomberg Wealth with the man himself, David Rubenstein, tonight at 9 p.m. in New York on Bloomberg Television. And it comes at a time where finally pensions are able to get the yield that they've been looking for. I remember when people used to say 8.5%, that's a pipe dream. You're going to have to lever up to get that in a zero rate world. Not anymore. David Rubenstein, I am so happy to say, joins us now, host of that show and co-founder of Carlyle. Let's just start there. Isn't this the golden era for pensions where they can actually get the returns that they need to get to meet their obligations?
Well, clearly, fixed income returns are much better than they were a year or two or three ago. But money pension funds in the United States, state pension funds, are underfunded still. And even CalPERS, which is the largest state pension fund at $465 billion, is underfunded. Underfunded in the sense that actuarially, it's about 20% below having full funding. Now, these pension funds are still in better shape than the U.S. government's Social Security program, which is not funded at all. That's a completely pay-as-you-go program, and that's much worse shape, relatively speaking, compared to the state pension funds. But some state pension funds are massively underfunded. Kentucky, Connecticut, Illinois are funded at maybe 40% of their overall obligation. So it's a challenge, and the fixed income rates that are now higher than they were before are a plus for those funds for sure, but there are many state pension funds that are still massively underfunded.
And this is a reason why there had been a concern in a low-rate environment of how much some of these funds would have to lever up to get the returns that they needed to become funded. At this point, do you feel like the risk-taking appetite, I should say, among some of these funds is diminished or has grown as they see the opportunity to actually meet those obligations without asking for additional contributions from members?
Well, I think a lot of the state pension funds are pleased that the fixed income element of their portfolio is now going to perform much better. So if you can get 5% yields on treasuries, you're getting very close to what you need to do, which is a 6.8% in CalPERS case. But most of the state pension funds are designed for actuarial purposes to yield about 6 to 7% or so a year. Some of them are able to do it and some are not. But I would say the easy money is probably behind them, which is to say the high-tech world, which showed some really great equity returns in recent years, that's probably behind most of the state pension funds now. They're really going to have to do the hard work of getting this without the high rates of return that you often got in venture capital or other kinds of private investments.
Money never feels easy, David. Come on. At what point has it ever been easy money at a certain time when people are looking forward? How much are they looking to private equity to sort of give that same kind of feeling going forward?
Well, private equity has performed pretty well over the last 10, 20, and 30 years or so for large public pension funds. And those that have done very well are the ones that have done enormous amounts of private equity. For example, the best funded state pension fund in the United States is probably the state of Washington. The state of Washington is overfunded by more than 100%. It has about 120% or so what it needs. And they have used a lot of private equity to get there. So those that were participating in private equity from the 1980s, 90s, and on have actually done pretty well. Some have lagged behind. I think the biggest issue you have now is that you have expectations are very high among employees about what their retirement benefits are going to be, and we have to make certain that we can actually achieve those retirement benefits. It's very easy for state legislatures to say we're going to give you certain benefits, but it's actually not as easy to earn those benefits, and therefore you either have to increase the taxation on everybody in the state, or you have to which means the state contribution to the pension funds is greater, or you have to increase the tax in effect that the pensioners or future pensioners are paying. And that's the only way you deal with it. You can sometimes get a higher rate of return, but there's no easy way. You either you either tax people higher, or you have to have higher rates of return. It's no easy way to get to the desired results. Now, as I mentioned earlier, Social Security system we have in this country is a pay-as-you-go system. So when I pay my Social Security out of my salary every week or so, that's going to fund benefits right away. We don't have a system like Canada or Australia or most countries where you have a funded national pension system. We're never going to be able to afford that, unfortunately, because we have promised benefits that are so high that we're just not going to be able to achieve the kind of system we have in Canada, where they fully funded, or not almost fully funded, the pension benefits that they promised their workers.
Not to diverge too much from the point, but isn't this part of the reason why yields have risen as much as they have on treasuries, particularly on the long end, as people take a look at that fiscal situation and don't really see an answer for how it's going to come more into balance?
Well, yields have gone up because interest rates have gone up, and that's made it easier for people who are fixed income investors to get a higher rate of return, and that will probably continue for some time. But I do think that it's an issue that all of us have to deal with, because we have a demographic issue in the United States. People are living longer than they were before. For example, when the Social Security system was set up in roughly 1934 or so, the average American lived to about 65 years old. And so you were able to collect your Social Security at 65. So there wasn't a big gap, because most people weren't living too much longer than they were going to be eligible to get their pension benefit from Social Security. Now, if the average age is, let's say, 81, 82, 83, you've got a big gap there, because people are retiring, let's say, and collecting their Social Security at 65 or 67 or 70, but they're living much longer. And in addition, we've taken the Social Security system and used it for so many other purposes. So we have a big gap, and in the end, the only way to solve that problem is increasing taxes on Social Security, which is hard to do politically, or you have to reduce benefits, which is even harder to do. So there's no easy way out of that problem. And
it's something that we're going to hear about politicians speaking gingerly about, certainly in an election season. Going back to this question around how some of the pension plans that do have to be funded are handling this, do you expect them to lean more into alternatives at a time where some people are questioning whether the golden era is over, whether we've already seen, particularly with the IPO market in stasis and the sense of takeouts not really happening to the same degree, that it's going to be more humdrum rather than the explosive returns and growth that we've seen over the past few decades?
Well, the market is more saturated than it was 20 or 30 years ago, there's no doubt. The returns will be harder to achieve, but there's no doubt that alternative investments, which may mean, I'd say, distressed real estate, distressed debt, buyouts, growth capital, venture capital, those things tend to outperform public equities by a fair bit. And as long as people need to get higher yields, you're going to see a fair amount of money going into these so-called alternatives. Will they outperform by the same amount that they did 10 or 20 years ago? Maybe not, but it will outperform. There's no doubt about it, in my view.
David, there's also a question around
this. The person I...
Go ahead.
Go ahead.
Well, I was just going to shift real quickly.
I'm saying the person I interviewed
to talk about whether there's going to be also a continued focus on ESG, et cetera, given the fact that there has been quite a bit of pushback. And I know that you did speak with Nicole Musico about that. What did she have to say about that?
Right. Well, ESG has become controversial in the United States. The controversy over ESG does not really exist so much outside the United States. Obviously, we politicize it in the United States to some extent, but I don't think ESG is going away. I think people will talk about it less. Larry Fink, for example, says he doesn't use the word ESG anymore, or the phrase ESG, because it's so incendiary in the minds of some. But the truth is that most investors want to have some sense that the investments they're doing are not destroying the environment or doing things that are, I'd say, not appropriate. But there's no doubt that some people have fought back, and there is a reaction against ESG in the United States. I don't think it's going to mean that ESG is going away, but people are talking about it more gingerly, let's say.
David Rubenstein, thank you so much for taking the time and for your really insightful interviews. David Rubenstein of the Carlyle Group. Thank you. You can catch his interview with CalPERS Chief Investment Officer Nicole Musico on Bloomberg Wealth with David Rubenstein tonight at 9 p.m. in New York on Bloomberg Television. A fascinating conversation at a time where, yes, yields are higher. A question, though, about what that means for longer-term returns on some of the riskier parts of the market, especially given some of the gains that we've seen so far this year. Coming up on Bloomberg TV at 12:15 p.m., Kelly Steckelberg, CFO of Zoom, after they delivered somewhat better than expected earnings, just slightly, as people continue to use that method of meeting, although perhaps less so than during the pandemic. Right now in markets, clawing onto those gains, second day of gains, this would be if it holds on, although fading just a touch as the session gets closer to that 9:30 a.m. open.